Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 331st VideoCast podcast for the week ending February 16th, 2026. We're doing it a little bit early this week, taking the family away for a few days to Whistler. Very excited to be with my friend Darrell, Garrett, etc., and Blake and team and their spouses and the whole thing. So super excited for that. As always, family first. I want to congratulate Mimi. Had a fun weekend of water polo. 4 games. They won all 4 games. Incredible team. She had a hat trick in one of those goals, a bunch of other goals, a 5-meter, a handful of assists. Annabelle flew with her team to Phoenix for a 4-day meet and had a blast racing new team. She went 158 in her 200 free and is starting to become just as strong in freestyle as she is in backstroke. So pretty exciting. Hope everyone had an incredible Valentine's Day. Want to thank my friends Jim and Parvina for having us to their incredible Valentine's Day party on Friday. This is a beautiful picture at their place, and thank you so much. We had such a great time, met so many wonderful people. That's at Valentine's with Mimi and Caitlin, of course. Then we had golf with my buddy Jason on Friday, super time. And then want to get down to a couple of these quick goals here because I love covering these. Here we go with the first one. All right, watch this. Watch this breakaway. Here goes Mimi down this side. Look at the pass from her teammate. How incredible was that pass? Boom, and she puts it away. Way to go. And then a couple other favorites, and we'll get down to, we got a lot of great business to get down to today. Here's another one. Boom, one-timer. That one was super quick. And then the 5-meter right here. We'll get right down to it. And here it goes. Boom. Mimi's signature skip shot. So great job all around there. As I said last week, I had the wonderful privilege to speak at USC Marshall School of Business. Want to thank, obviously, Professor Shane Shepard and Jason Greenblatt, who is a student in Professor Shepard's class. He also runs the Value Investment Club. They run $7.5 million of the school's money live. He had a great AMA at the live presentation I did. We're going to listen in here. This is super important because, one, the question and answer from the students was incredible. But 2, I really go into some detail about our investing framework. You're going to pick a lot of gold nuggets here. So let's get right down to it.
And long short value investing standpoint, and has got his podcast, Hedge Fund Tips with Tom Hayes.
Yep.
To listen, so recommend that one as well. I'll let you take it away.
All right. Well, thank you. I remember when I was sitting in your seats just 27 years ago. I know I look young for my age, but kind of old, and that's a good thing because I'm doing what I love and we enjoy it. So, originally we were going to do a few names and we were going to go into depth and all that. And my analyst, who just graduated from Florida State, actually, who's very tenacious and was on me for a year and a half and has now been phenomenal and totally understands the framework. He was a student of the podcast for 4 years. He said, if you're going to go talk to the students, you're probably better off taking questions than just giving a lecture, because they get lectures every single week, which I'm sure are great, but probably more helpful if we're more interactive. But I do want to give you a little background so we can be on the same page, a little bit about where I came from, how we invest. And I was sharing with, it's okay if I call you Professor Shane?
Yeah.
Okay. Kind of, when people think of Tom Hayes, when they think of Great Hill Capital, they think of value manager. But when we look at the returns of the value indexes relative to the returns that we've been able to generate, there's zero correlation. So we're going to try to maybe give you a little bit of that. I wouldn't call it secret sauce because we have a podcast every week for the last 6 years, but some of the things that have made a difference in our framework and how we're able to generate alpha for our clients. And then advice, well, as we always say, opinion, not advice, but I guess when it comes to careers, I can give you some advice. And life lessons and long-term thinking. So that's kind of the framework of what I want to cover. Before starting Great Hill Capital, I was with a firm called Cornwall Capital Management. Did anyone see the movie The Big Short? Okay, so I worked for Brad Pitt. His name was Ben Rickett in the movie, Ben Hockett in real life. Much less handsome in person, but probably 10x smarter than Brad Pitt. One of the smartest guys I've ever met. Still talk to him pretty regularly. Just an awesome group over there. And then prior to that, I was at a firm. The principal was friends with Warren Buffett for 40 years. So sometimes it's better to be lucky than to be good. I grew up in the New York value mafia, going to hedge fund dinners with Lee Cooperman, with Mario Gabelli, and that ilk, and flying out to Omaha once a year to see the Wizard and learn from the greatest in the business, and I'm very grateful for that. And in that position, my boss was kind of stuck in this position. It was like a microcap company, and he said, look, I'm going to make you COO of the public company. I want you to go in, sell off all the non-core assets. There was a hardware distribution company, a piece of land in Pawling, New York. And I did that, and we raised $30 million of cash. He said, good job. Now go out and buy an asset management firm. And so I spent the next 12 months interviewing over 100 firms. I saw all different strategies, what was durable, what worked, what didn't work, what was useful in running a business, what didn't work running a business. And we purchased one, $1.6 billion under management. I got the whole firm for 1 times revenue. It was $6 million. It was break even, and the stock doubled. And that was kind of my first foray in doing deals, first foray in being a public company C-suite. So that was a tremendous experience. But basically, learning every strategy, every product that was out there was invaluable. Okay. So we run a concentrated equity portfolio, and what that means is we run 8 to 12 stocks. And Professor Shane, I'm sure, has done all the academic research. It's not impossible to outperform with more than 15 stocks in your portfolio, but the odds are dramatically against you. And you'd be like, well, how is that possible when all active managers have 30 to 100 stocks or more in their portfolio, and every financial advisor has their clients in hundreds of stocks, et cetera, et cetera? It's just math. And what we try to do, and I think if you get nothing other than this framework and you go into this business, it will serve you very well, is we do something that a friend of mine actually encapsulated what I do better than I ever could. We basically do private equity in public markets. So what that means is if we wouldn't buy 100% of the company with 100% of our net worth, we won't buy one share. Okay? How many of you have that filter before you go into a stock position on Robinhood? It's going up, I gotta get it, before class, and that's the tuition you pay. That's what everyone goes through when they first get exposed to markets. The question is after you blow up your first account, and you will. I know you guys are smart. You're at USC. You will. I guarantee you're going to chase a shiny object. You're going to wake up. They missed earnings by 2%. It's down 60%, and you were triple levered long, and you're toast. Okay. But if you actually get up off the ground after that, after you've paid your tuition, you more than likely never make that mistake again. And if you do make that mistake again, you won't make it a third time because you definitely won't be in the business. I guarantee you, 100%. So, and then we have the hedge fund tips with Tom Hayes. It toggles back and forth between 1 and 2 in the hedge fund category. I know Jason is a fan. He's learned tremendous money, but I was like, I don't really care what you learned. Have you made money? And he said he's made a good amount of money, so that's what we like to hear. If you're interested in the value framework, that could be a tremendous resource, even going back to old episodes or listening to new episodes. But the concept, our entire theme of what we do and how we do it is from Warren Buffett, the master. And some people say, well, Elon Musk is the master. Warren Buffett made $400 billion. Okay, he gave away $200 billion. That's why everyone's like, well, he's not that rich. He's only worth $200 billion. No one has ever compounded money better than Warren Buffett. Okay, and no one has ever been a greater wealth creator. And his framework was the framework that we adopted, which is great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. What does that mean, misappraised? It's misappraised in price relative to the underlying fundamentals of the business. So the types of businesses that we buy are very boring businesses that have been around for a very long time. And the revenues tend to grow like this, that trend up over time. The cash flow trends to trend like this over time. Margins hopefully are flat, not going down too much. But the price, because of public markets, vacillates like this. And what we're trying to do is buy it here. We never do. We usually buy it here, and then we have to buy more. Then we have to buy more. And then it goes up, and we sell it here, and it goes up more. And we're like, and everyone says, oh, you're an idiot. And then it goes back down, and we're like, we weren't that dumb. And that's probably my best advice. Just don't be that dumb. And if you can get through a career without being that dumb, you can make a lot of money doing this for sure. So that's number one. Number two, there's the old saying, who's read The Intelligent Investor by Ben Graham? 3 people, 4 people, okay. That's the Bible. I would say if you read that and it's not life-changing, go be an entrepreneur. Because what we do, and the older I get, the more I realize it's genetic. The skill sets that make one very successful in investing are the opposite skill sets of what make people very successful in the real world. In the real world, you are compensated for massive action equals massive results. Take a lot of action, make a lot of mistakes, keep getting up, keep going, and eventually you'll get to your goals. In investing, it's the exact opposite. The more action you take, the more likely you're to lose. Okay, and the people that do the best are the ones that have a durable framework, filter it through their framework, make the investment as if they were buying the whole company, underwriting it as if they were buying the whole company, and then they sit tight and play the time arbitrage game. Why? Because in the short term, as Ben Graham would say, the market is a voting machine, and I've added based on emotion. In the long term, it's a weighing machine based on fundamentals. So I think Charlie Munger said it best when he said, it's very hard to buy a business that compounds capital. Does anyone know what return on invested capital is? Okay. At 10 or 20% per year over the long term, that the stock price over time does not compound at 10 or 20% per year. So in the short term, it might be like, why is the stock down 50%? And then there'll be another part of the cycle where it's trading at 80 times earnings and then 20 times. But over time, it's going to follow the ability that they have to compound capital for the owners. Okay, and that's really all we do. And then we ignore all the headlines, we ignore the shiny objects. And my biggest joke is does anyone know what FOMO is? Fear of missing out. You guys have that? Okay. When God was handing out FOMO genes, he missed me. Okay. I have zero FOMO. Like, I stay in my lane. I do what I do. We look for doubles and triples over 3 years, rinse and repeat, boring, predictable, durable companies. I don't have to predict who's going to cure cancer. I don't have to predict who's going to win the AI race. I don't have to do any of that. I can buy a boring ass company like Generac, okay, which, by the way, reported this morning. And why is Generac up? Not because they own 75% of the home standby generator market, because they do the backup generators for data centers. Okay, so free option, stocks up. We were buying it down 85% at $85 and $90 when you couldn't give it away because they overstocked during COVID.
They went through the destock cycle, the restock cycle, and now we've got this tailwind. This will be a $250+ stock from $85. Okay, so you don't have to guess the future. You just have to buy good businesses when they're tremendously out of favor. And do it with low to no margin, so you can stay in the game long enough to get the benefit versus sweating bullets and the Robin Hood margin clerk calling you. Okay. Next one. Okay, so this is a good point. Let me actually back that up. We profit on buying on weakness and selling on strength. Okay, driven by deep research and the belief that the greater price dislocation, when you have a good fundamentals under the surface, it reduces risk. Okay, when stocks drop a lot, most people say, I can't buy that because it's risky. Okay, it's actually getting de-risked as it comes down in price. And everyone wants to buy the ones that are up a lot in hindsight, and those are the ones with the greatest risk. Anyone own software stocks in the last 2 weeks? No one wants to admit it? Probably all of your Robinhood accounts are soaked with the stocks that got hit in the last couple of weeks, because that's what everyone was doing without any respect for valuation. And sooner or later, when the tide goes out, everyone sees who's swimming naked, as Warren Buffett would say. So buying on weakness, selling on strength, driven by deep research and the belief that the greater price dislocation reduces risk. Where others see volatility as danger, we see it as opportunity, provided the fundamentals are sound. So our average time horizon is 2 to 3 years. We talked about the short-term voting machine versus the long-term weighing machine. I like to say that we're in the time arbitrage business, okay? How we're able to achieve alpha for our clients is that, people call me Iceman because I have ice in my veins. When the stock's going against you, buying it at a discount to intrinsic value, price always, if you want a guaranteed stock that's going to go down in the next 2 weeks, buy something right after I announce it on the podcast. It's guaranteed 100% the next 2 weeks it will go down. And I guarantee you we will be in the market buying more from the weak hands. And then all of a sudden, when everyone forgets about it, it starts to trickle back up. It goes up a lot. It doubles. Everyone's very interested. We're not ready to help them out yet. 2.5, we start to want to help them out of the kindness of our hearts. They want our shares more than anything else in the world. We start to help them out with a few of the shares. And at 3x, we give them all that they want. And they want it like it's going out of style. And and that's really all we do. I wish it was that complicated. So what we're able to do is to drown out the noise, avoid being swayed by Mr. Market's emotional up and downs. And I say this all the time, Wall Street's the only place when they hold a clearance sale, everyone runs out of the store versus in the store. So we've got some ladies in here. Brandy Melville, popular. Okay, I have 2 daughters. Like, they're there all the time. Every time I'm there, it's crowded. If there was a clearance sale at Brandy Melville, I mean, they'd be running faster than anyone could even imagine. At Wall Street, you could have the best businesses in the world down 50, 60, 70%, and everyone's running away and they can't get rid of it fast enough. And if you can just shift the mindset when those periods of dislocation happens from fear to opportunity, that will give you the opportunity to outperform over time and do everything you want to do. So, all right, South Sea bubble. What I found, and by the way, if you're listening to this and saying, oh, he thinks I'm going to blow up my account because I'm young and I don't know any better, I'm going to say this. I'm in a number of groups with peers that are, net worths that you could only dream about, okay? And these people trade stocks the same way you do. And then after they lose like a third of their wealth, like 100 million, and they still have 200 million, they call me and they say, I can't do this. I said, that's smart. I will manage it for you. You go out and build another business because I can't do that. That takes too much work. You go out, do massive action, get massive results, make another 300 million. I'll take your 100 million and I'll grow that doing what I do, which is sitting on my ass and picking stocks and doing a really good job at it. Okay? So it's universal. And the reason it's universal is because it's how we're wired as human beings. So Sir Isaac Newton, one of the smartest people in the world of all time, maybe you've heard of him. Anyone want to chime in? What was he famous for? Okay, what else? Gravity, figured that out. That's pretty good. So he wasn't a dumb guy, okay? But he was also a human being like everyone else, and he got caught up. And there was something called the South Sea Bubble. And it shows that temperament is more important than intellect. We think if I'm going to hire a money manager, I want the one at 165, 170 IQ, not the one at 135, 140. I'm going to say, let me see how they act under pressure. What do they chase the crowd when things are euphoric? Okay, any of you guys own Bitcoin the last few months? Okay, some honest people in the room. The rest of you are a bunch of liars, but okay. That's the equivalent of chasing shiny objects. And I have no view on Bitcoin because it's not what I do. It's a non-productive asset. Plenty of people bought it when it was nothing. They gambled, they got rich. They had an edge. Maybe it'll go up to $1 million. I don't know. Ask Kathy Wood. She seems to know certainly what it's going to do. I have no way to value that. But so he invested a bunch of his money in this stock, which was the hottest thing of the day. Anyone heard of Tulip Mania too? Similar type of thing. Madness of Crowds, Popular Delusions is a good book. I would Google that. But he made a double, and he was super happy. He made a ton of money, except for the fact he noticed that all his friends stayed in the stock and were becoming wealthier than him. So the stock kept going up after he sold, and it kept going up more. And finally, he had had enough. He saw his friends getting wealthy, and he took all the profits that he made in the stock, and he put it in before the top, kept going up, and he exited effectively broke. One of the smartest guys in the history of mankind. He fell prey to the same thing that happens over and over. So for all of you worried about, is AI going to disintermediate the stock market? Is it going to disintermediate human emotion? It's always going to be the same thing. We're always going to have euphoria. We're always going to have panic. The key is to be on the right side of the trade. So if everyone's interested in something, maybe you can ride that momentum, and some of you will be smart to figure out how to get on there and get off at the exact right time. Very hard to do if you're managing hundreds of millions or billions of dollars, because you can't get out with a 7% stop loss like you can with a few $100,000 in a trading account. But I think you'll be better served buying quality assets when they're out of favor. And I'll say this, Munger and Buffett kind of differ. If you look back at Buffett's greatest performance years, it was when he was doing what I do. He was running partnerships for outside investors. And during that period of his career, he was a Ben Graham acolyte. Ben Graham was his mentor. He was buying good businesses at great prices. Okay, good businesses at great prices. And Charlie kind of came along and he said, I taught Warren how to buy great businesses at good prices, and it changed the whole game, except the performance went down. So the only thing that changed for Warren Buffett is not that he had some royal epiphany because Charlie Munger whispered in his ear. What happened was his capital structure changed. So when he was running partnerships, it's what we call temporary capital. If you do a good job, they give you more money. The minute you do a bad job, they forgot all the good that you did for them, and they call you up and say, I want my money back. So he had to have maximized performance all the time by doing what he does. Once he got the permanent capital structure of the insurance and the cost-free float, which is basically a leveraged hedge fund without margin cost, the law of large numbers forced him into large cap stocks, which by definition had a moat, which by definition were great businesses, but he was buying them at good prices. So it wasn't that he had this change in philosophy, it was that his incentives changed, so the strategy changed to match the incentives and to match the structure in which he was managing capital. So the likelihood of you managing inside a permanent capital vehicle are not impossible, but they're low. The higher likelihood is you'll be managing impermanent capital, which means you have a constant pressure and opportunity to perform on a 12-month basis. I happen to love pressure. I'm genetically defected in that way. I'm genetically defected to buy stocks when people say they're uninvestable. But it's worked well in this very narrow lane of life where lazy people who have genetic defects can make a lot of money. And that's what I've done with Great Hill Capital. So when you think that there's something wrong with you chasing shiny objects and then blowing up your Robinhood account, just say, well, happens to the best of us. Sir Isaac Newton had the same problem I do. And then you say, do I want to keep doing this, or do I want to change my framework and do it on a more business-like basis? I tell a lot of the really successful entrepreneurs who are clients, I said, if you were going to buy a competitor to expand your business, growth by acquisition versus organic growth, the way you would analyze that business is actually very rational and very similar to the way that I analyze public stocks. The difference is when you're buying that 30th car wash or that second or third healthcare service provider, you're not seeing a stock price on a screen go up and down like this. You're saying, what am I paying and what am I getting? Okay, so if you're going to buy a Subway franchise and you say, okay, tell me the numbers. Does $1 million in revenue a year. After we pay all the employees, we pay for the salami, we pay for the bread. Makes $100,000. You walk to the seller, he goes, I want 100 million. You'd say, that's crazy. Why would I ever pay you 100 times sales for a business that makes $100,000 a year? And yet, you all do it in the stock market on your Robinhood accounts every single day. And you wonder why it doesn't end well, okay? And everyone does it, whether you're worth 3 billion, 300 million, or $30. It's just human nature. And if you can just dispassionately step back and look at the business as if you were buying the whole company, your performance will be tremendous relative to your peers. Next. All right, so my nickname on Wall Street is Turnaround Tom. We tend to buy things that are out of favor. So sometimes things get impaired in price because they deserve to be impaired in price. Maybe they are permanently impaired. So you could buy something down that's 90%, it drops another 5%, you lost 50% of your money, okay? So our ability is looking beneath the surface saying, number one, it's been in business for a long time. How has it handled itself through other cycles? Is this cycle that different? Is it a temporary impairment of the business due to the cyclical nature of the business? Or is it a permanent impairment and this business is toast? Kodak, they used to make these like snappy cameras that everyone would have, Polaroid. Gone. Gonzo. I'm sure you could have gotten down 90%, could have also gotten it down 100%. So what's the first thing that we do when we're looking at a turnaround? Number one is we assess solvency risk, balance sheets, okay, liquidity profiles that allow the company to survive long enough for our thesis to play out. Okay, they might have a good turnaround plan, but if they don't have liquidity, they have too much debt that they have to refinance, they're toast, okay? So that's number one. And number two, we don't want them to issue a lot of equity in a desperate situation because then our same slice of the pie, which maybe there were 8 slices of the pie, they issue a ton of equity. Now there's 1632, so even if they're successful and they 4X, we're back to where we were, which is not really helpful, okay? So that's where we have to assess management. And as we say on the podcast, I know some of you don't listen, but we got to make sure they're not scumbags, okay? Have they issued a ton of shares? See, I'm from New Jersey. Scumbag is a normal word. I know in California it's like, oh, this guy's pretty rough. And what I call scumbags are those management that issue a ton of shares at the exact wrong time and dilute out their owners in order to save their own job. Okay, so they don't respect equity, they don't respect ownership, and I got to avoid people like that. And how can you do due diligence? You just see what they've done at the last few companies that they've been at. Usually if they're brought in for a turnaround, they have some history of doing turnarounds. How did they behave? And past is often prologue. People don't change that much. They either get it or they don't. The moat. Is it a durable competitive advantage? Strong brands, structural positioning built over long operating histories, and proven through cycles that protect margins, support pricing power, and compound value. That's the qualitative analysis that you're going to have to get good at. Is this a temporary impairment? Is this a permanent? Part of that is pattern recognition, and it's just time in the business and experience. You got to read a lot. You got to pay attention. I mean, I go shopping with my kids. I'm doing channel checks on every store. I'm checking Vans. I'm checking Estee Lauder. I'm checking Nike. I'm checking Lululemon. Any women still wear Lululemon, or are you all aloe? Just curious. Any guys wearing Lulu? Okay. Are you new Lulus in the last 2 years, or you've always been Lulu and you stuck with it, or you're wearing Lulu because you bought it 2 years ago?
Personally, always been stuck with it.
Okay.
Yeah, historical, yeah.
Yeah. Canada Goose, my man right here. All right. Anyone else? Record free cash flow, record revenues, stock down 80%. We like that one. And then finally, catalyst. It's okay if you have ADD. It's fine in the investment management business. You just have to focus long enough to read the annual reports, the quarterly conference calls, and if you have enough money at stake, you'll focus. It's like, I'm not really good with numbers. Put a dollar sign in front. We'll see how good you are with numbers. You get really good with numbers really fast. All right, a clear identifiable path to unlocking value driven by concrete business change rather than valuation alone, such as a turnaround plan, new leadership. We're always betting on the jockey. That's really important to us. Cost cuts, asset sales, or activist involvement. We're looking for a lot of optionality. Okay, we'll talk briefly about a company called VF Corp. They had a handful of brands. They've been trading in and out of brands like Timberland, North Face, Vans, JanSport. Anyone have a JanSport backpack? Eastpak. Since 1899. Not 2009, not 2019, 1899. They've been doing this for 125 years. The stock was down 85%, like they're going out of business, like they forgot how to do what they've been doing for 125 years. And they kind of did, but they had a lot of outs. They had 5 brands they could sell and pay down their debt and deleverage. They brought in Bracken Darrell. We'll get to that. So, you know, as the tagline says, we invest like private equity in public markets. If we're not willing to buy the entire business, we will not own a single share of the stock. Every investment must pass 4 core filters: solvency, shareholder-friendly management, durable moat, and a clear catalyst to unlock value. And that's why when you overlay our strategy on a value index, there's zero correlation, because they're just buying cheap for cheap's sake, and a lot of stuff is cheap for a reason, and there's no catalyst to turn it around. Good example of that would be Xerox. I mean, someone asked the AMA question last week, and I don't see any catalyst. It's cheap. I keep looking at it. I can't find any catalyst to turn it. So maybe they'll reinvent the wheel, but so far it looks like Kodak. VF Corp. So we began building a position in this thing down here, and then it got lower. We bought more, and then it shot right up to 28 after Bracken Darrell came in. And we looked like geniuses, and then it came right back down, even went lower, blew out a little bit. We bought more. Nothing changed in the thesis. As a matter of fact, it was de-risked more because he had sold off a couple brands, paid down some debt, and North Face was running on all cylinders. Timberland was starting to hum. A lot of optionality, and I kept doing channel checks on Vans, which is now finally starting to turn the quarter. So they did a dumb deal with Supreme. Every one of you wore Supreme 4 years ago. No one wears it now, so they had to dump it in the hole. Bad investment. And we believe temporary headwinds have masked a portfolio of iconic brands, turning VF into a textbook self-help story for refreshed leadership and to restore the basics. Next slide. How are we doing on time? Okay, I'm not doing too bad. So, founded in 1899, VF Corp has evolved from a glove and mitten manufacturer into a global apparel and footwear powerhouse through decades of acquiring and building iconic brands. Today, its 10-brand portfolio is led by the North Face, Vans, Timberland, with 51% of sales from the America, 34% from Europe, and 15% from Asia Pacific. One of the themes that we've had in the portfolio, partially on purpose, partially by accident, is we want to be in companies that get a lot of their revenues from abroad because we've been kind of ahead of the curve with the weak dollar thesis. Some people played it through gold. We played it through more predictable methods in being in companies that will get an earnings tailwind from a weaker dollar over the next few years. Next. By the way, how many of you know these brands? You want to go back real quick? So you got Altra. Anyone using the Altra running shoes? Their growth is going through the roof off a really small base. Icebreaker, Kipling, JanSport, Eastpak. I thought they were going to sell JanSport first. They sold Supreme first. They sold Dickies. That was kind of dead in the water. They got some cash, paid down some debt. Okay, let's move on. So they sold Supreme, they sold Dickies, they've de-risked the balance sheet through $1.5 billion sale of Supreme, $600 million sale of Dickies, using the proceeds to pay down debt. Management reduced leverage by a full turn in fiscal year 2025, paying down nearly $2 billion. Net debt stands now at $4.2 billion, tracking below 3.5 times by year end, and ahead of schedule toward the 2.5 times target by fiscal year 2028. So they're doing everything that they said they were going to do, which is what we look for in management. Next. Okay, this was the core reason that we got involved with VF Corp, is a guy named Bracken Darrell. Okay, so these things, Logitech. Is there anything proprietary or cancer curing or revolutionary about this piece of plastic that you can buy from China for $1 and sell for $20? Absolutely zero. So when he got involved in VF Corp in 2013, in Logitech, that was his previous turnaround. Before that, he was at Procter & Gamble with Old Spice. He ran that whole marketing thing. It was very successful. The stock was also down 86%. Over the next 8-9 years, he had a 26-bagger turnaround. Not because he invented the internet like Al Gore, not because he cured cancer, but because or hepatitis like Gilead, but because he took this boring commoditized business that was beat down and he reinvigorated it and he ran some fiscal discipline and he turned it around. The exact same playbook that he's running for VF Corp. He knows brand marketing, he knows the value of franchises. So if you had invested $1 million when he took the helm, 10 years later, you had $26 million. Beat pretty much any index by several orders of magnitude, and then some. I don't know if it beat Bitcoin or not, but we'll talk about that another time. But this guy's a winner. First was Old Spice. He tripled market share in 2 years, followed by a 26-bagger over 10-year at Logitech. His next turnaround, and he has serious skin in the game, having purchased $3 million of stock personally. So that's a real partner. Fake partner is by title. A real partner writes a check next to you, so you both have something to lose, real skin in the game. And he has 90% of his compensation tied to financial targets. That's a critical factor. That was one of the key reasons we got involved in a company called Cooper Standard. Their compensation, we started buying that in May of 2022. Jason probably knows the story. Just over $5. It immediately, down from 146, by the way. They make the rubber sealing around the doors and windows for new cars, fluid transfer systems. Very, very exciting. Very super exciting company. It immediately went to $350. We bought more. Today it's at $35 and change, and it's going to $100. Huge amount of operating leverage, refinance the debt, right management to turn it around, right part of the cycle, et cetera. So they were incentivized on the basis of return on invested capital. So they're not going to dilute me, because if they dilute me, they're not going to get the return on invested capital that they need to get paid. The incentives were aligned. Like Munger says, show me the incentive, I'll show you the outcome. If you look at Enrique Lore's new pay package at PayPal, he has tens of thousands of reasons, aka stock and RSUs, to get the stock over $125 in the next 3 to 5 years. So, you know, anyone here use Venmo? You guys heard of Venmo? Yeah, everyone? It's growing at 20% a year. PayPal owns that. Most people don't know that. Anyone take an Uber in the last 2 minutes? 2 days? Everyone? Yeah, every time you pay Uber, you're paying PayPal because they own Braintree. It just doesn't say PayPal on the button. Most people don't know that. You would see, I don't want to get ahead of myself with the questions, but after earnings, you would think free cash flow was negative, revenues were down 20%, stock crashed. The opposite was true. Revenues were up, margins were up marginally. Guidance was a little bit weak. They generated $6 billion of free cash. They bought back 10% of the company last year. Can't give it away. It's Alibaba Part 2. The only difference is it's not uninvestable because we don't have to worry about Xi Jinping's new policy headline and the stock getting de-risked, so we have to buy it in Hong Kong because we're scared of, you know, what Rick Scott's going to do in the Senate and delist the stock. So that was like real risk. This is like Mickey Mouse risk. This is like, they're just, it's a cash machine and you can't give it away. It's like, please take my cash machine. Okay, I'll take as much as you want. Everyone else dumping in the hole. Yeah, okay. So next, growth is inflecting. After 3 straight years of revenue declines, VF top line is inflecting with over 75% of the portfolio now back to growth versus 10% 18 months ago. Vans is stabilizing as a value channel exits. As they exit value channels and inventory cleanup are being lapped with brand heat rebuilding under President Sun Cho, who came from Lululemon, by the way, the return of the Warped Tour and high-profile collabs with SZA and K-pop Demon Hunters, targeting a return to growth in 2026. I went to the flagship store in New York. They said the only problem with K-pop Demon Hunters is we didn't have enough on the shelves. It just kept selling out and selling out and selling out. And then the Vans with the, you know, the puffy thing on the side that the young kids wear, those are selling out. So we'll see what happens. North Face delivered 8% growth in Q3 with a long-term plan to 2 times the apparel and equipment and 3 times the footwear sales as the Skims collab became the #1 selling in brand history with Kardashian. North Face and Kardashian did a thing. Timberland posted 8% growth, marking its 5th straight quarter of global expansion across DTC and wholesale with major distribution push just beginning. VF reestablish a durable 3 to 5% annual growth profile over the next few years. As growth normalizes, VF should return to its century-old playbook of growing and buying and building the next generation of hot consumer brands. Next. Okay. Margins are starting to inflect. That's a clear sign in a turnaround, okay? With clear path back towards historical 10% plus levels through cost cuts and operating discipline. Our math suggests that translates into nearly $2 per share in normalized earnings power over the next few years, implying a potential double on normalized multiple. But what happens is, these are the 3 most important words that I learned from my first boss. You can write them down. Some of you will get it right away. Some of you will never get it. But these 3 words changed my life. Opinion follows trend. Okay? All the sell-side analysts, they downgrade in the hole, and then they have to chase up. After the price starts to go up, they all start to upgrade and chase up. So they're pessimistic at the lows. They're optimistic at the highs. Morgan Stanley upgraded Alibaba at $300 when it was down from $319. They then subsequently, after upgrading at $300, they downgraded it at $60. Okay, so unhelpful on both sides. So what happens is, as the business starts to perform, you don't just get earnings power goes up and therefore the price goes up. You also get a re-rating and you get multiple expansion because it starts to turn back into a growth story. So you get 2 bites at the apple, and that's kind of the magic of turnarounds. Okay, next. All right, how to get started in investing. My best suggestion, and by the way, I will say this, there are plenty of ways to make money in life. This isn't the only way. There are plenty of ways to make money in the markets. This is the only way. This isn't the only way. This is the only way that I'm good at, where I can achieve alpha, so I stay in my lane. I think there's a value into having a discipline. Find something that you're better than most people at, or really exceptional at, and just stay in your lane and do it better than anyone else. So I would read The Intelligent Investor first by Ben Graham. You'll have a light bulb moment and quickly know whether this style of investing is for you. If you hate it, it isn't. Cut your losses. Go build a company, make $1 billion. I'll manage 100 of it for you. Okay. Read everything Warren Buffett has ever written, every single annual letter, both when he had the partnerships and when he had the public company. That's worth more than. I'm not going to say that, but it's very valuable. I would say say do that. Work through CFA materials and start building real investment pitches. Follow the markets daily. Analyze businesses and practice turning ideas into written investment cases. This business rewards curiosity and people who love the craft. If you enjoy the work every day, it feels like a treasure hunt and you will skip to work. If it feels like a grind and you're doing it because your parents said this is how you're going to make the most money as an adult, cut your losses. You'll never compete. It's just too competitive unless you absolutely love it. This is a craft. It's learned through reading, thinking, and building real investment work over time. If you do not love the process, the business is not for you. As Warren Buffett says, the people who are the most successful are those who are doing what they love. Okay. Now, on the flip side, I will say the worst advice that most people give to college classes is find something you love and you'll never work another day. That's not true. Like, I love eating ice cream. I'm not going to make a lot of money doing that. So don't get faked out by that. But you'll know if it resonates you. You'll kind of know in your heart of hearts. And if so, then pedal to the metal. It doesn't mean you're going to hit brick walls. You are going to hit brick walls. And the key is, how do you deal with it? You get up, you dust yourself off, and you just keep going. And that's that. So I think that's all the prepared remarks. Offer value first. It's kind of how I built my business. The fastest way to differentiate yourself is to offer value before asking for anything in return. Take initiative, do real work, and create tangible value. This may not pay off immediately, but over time it compounds into outsized opportunities. To get what you want, you first have to deserve what you want. And the other thing is, to get what you want, you got to help enough other people get what they want. And I found, by complete accident with the podcast, some of the best people that work for me, some of the best people that have become investors have all come from me putting that value. And 95% of the people that listen to the podcast and make a ton of money off my ideas, they'll never do any business with me. I get the joke. That's just putting out good into the world. And then 5% will understand it. And I've been very grateful for the people that have seen the value and entrusted me to run some of their money for them. So that's that. And I think that's it. Is that the last slide? Yeah.
3 lessons.
3 lessons, okay, that matter most. Most outcomes are shaped by behavior, not intelligence. Progress compounds quietly before it shows up publicly. It's the things that you're doing in private, the reading, the learning, the curiosity. And then patience is often the highest return decision. It's doing the work, sitting on your hands. In investing, you get compensated for massive inaction. In the real world, if you're going to build a company or a career, you get paid for massive action. So just know what you're good at. If you're a lazy bum, investing is for you. If you want to work hard like crazy, go become an entrepreneur or build a career. Long-term success has very little to do with brilliance, temperament, patience, and consistency. Stay in the game long enough, and compounding will take care of the rest. I think I got, if I think about just the podcast for 6 years and what's happened to assets under management, first 3 years it was just like this. And I wasn't even I didn't even start it with that intent. I got a phone call from a guy in California. He's like, hey, number one, I had a tough time reaching you. And number two, are you managing money? I'm like, no, just my own. And he's like, sorry to hear that. If it ever changes, let me know. And anyway, started managing money for him, doubled it. He gave me more. His friends started calling me, blah, 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 blah. And now it's just gone crazy because for 3, 4, 5 years, people have been watching me, listening to my ideas, seeing them work out in real time, realizing that, they either don't have the temperament or they don't have the time. But it's the wealthiest people, they all outsource. They just hire the best people. They're smart. That's how they got wealthy. Like the poorer people, they all try to do it yourself, and then they got to pay the cost of tuition. They lose 5 years of their life. But in your 20s is a good time to lose 5 years of your life, because that's an investment that 10 years out, 15 years out, you're going to be able to make whatever you want, because you'll have, had the experience, recognize the patterns, taken in all the information you need, have the foundation, the framework. It's like if you think about constructing a skyscraper, you drive by for like a year and it's like, man, what are they doing with that building site? Like it's been fences and like dirt for like a year. Nothing's happening. What you don't see is under the surface, they've been laying the foundation, and you see zero progress for like a year. And then all of a sudden you go by the next week and it's like 5 stories are already up. You're like, holy cow, the building's halfway done. How did they do it so quick? It's like, because they laid the foundation. And when it comes, and I'll say this, whether it's a stock that you've done the work on, career, when it comes all at once. So if you guys are looking for linear outcomes, like, oh, boss, I worked 10 hours today. Why am I not getting a huge bonus at the end of the year? It goes like this. And sooner or later, you become so valued that your compensation just hockey sticks. But if you expect to be valuable here, you're never going to get to here because you're impatient. And then you just get washed out. So on that positive note, any questions?
Question.
Ethan's going to hand out the mic to whoever has the questions so we can get it properly. Yeah, please.
Which way do I? This one?
Yeah, that's fine.
You talked about a lot of the qualitative aspects of, Great Hill Capital strategy. What are some of the key ratios you guys like to look at when you're analyzing a company? And then follow up, I forgot what you called it, but when you're going in and channel checks.
Yeah.
How often do you do those before every single investment? So yeah, those kind of 2-pronged question there.
This is a great question, not for the reason you think. Some of the best companies that we've bought, when we purchased them, were trading at over 100 times earnings. And you're like, well, wait, I thought you were a value investor. So they would never show up on a value screen, which is why we have zero correlation to the value index. So what we look at is, what does normalized earnings look like? What does normalized cash flow look like? Because if you were earning $2 and you just took a huge write down and now your earnings are 2 cents, it makes sense that you're trading at 100 times earnings because the market and people miss it. So we don't pay a lot of attention to ratios. As a matter of fact, I don't even know if we've ever pulled up a ratio during an Ask Me Anything question in 6 years. We look at cash flow, we look at balance sheet. Free cash flow yield is kind of a decent place to start. We're interested in return on invested capital over time. What does normalized returns look like? Is there an actual moat in this business? We want to look at the balance sheet, the debt ratios, but that's kind of all the process. As far as screening for something that gives us turnaround time possibilities, there is no screen. We look at 1,000 stocks every couple of weeks and just see what's down a ton and why is it down. And I spend 99% of my time figuring out how to say no, not yes. I'm not looking for the next opportunity. I'm looking to disqualify every opportunity so something can fit in those 8 to 12 slots. And that takes a lot more discipline than like, oh, this looks good. And then you gather all the research confirmation bias that supports your instinct because the price looked like a certain way. So that's that. Your second question was?
Channel checks.
Channel checks, that's a part of it. I think, some people go crazy with channel checks. You have hedge funds that buy the credit card data, but like, our average holding period is 3 years. Some take 5 years to be a double or triple plus. Some take 1 year. They happen faster than we thought. But we're doing channel checks ongoingly. Like I go to New York, I go to Canada Goose, I go to Vans, I go to Timberland, I go to North Face. I do it, in Newport, Fashion Island with the kids. And, you talk to competitors, you find out, best thing is to ask a competitor if you had to own 100% of one of your competitors, which one would it be and why? You can, go see other companies in the industry, talk to management, and instead of asking them about their company, ask them about like who's the worst run business, who's the worst manager, who's the one you're not worried about, who's the one that you'd love to own if you could own any of them for the next 10 years. So doing that type of work is pretty valuable. Yeah. You don't need a drone over the parking lot at Walmart. It's okay. They could miss next quarter and it could still be a good business.
So obviously thanks for coming. I have two questions. First one is, when you're underwriting a business, how do you think about cost of capital? I feel like in my time here, I've run into a lot of companies that have a ton of debt because it's more of a turnaround story, and that artificially lowers the academic cost of capital. Do you use an internal cost of capital? And then secondly, when you're thinking about when you get out of a position, a lot of that has to do with like the long-term growth of the business, right? How do you think about that versus like GDP or a metric like that?
Yeah, it really depends on a company by company basis. The way we're gonna think about like Albemarle last year, if you remember that one, it got down to $58. It's a very cyclical. We wanted to get exposures in materials because materials were dramatically out of favor. So we, looked at all the companies in materials and see which ones are down a lot. And Albemarle's been around for decades and decades. They're one of the leading lithium providers, lowest cost producer. But they trade with the commodity, and we just kind of looked at the commodity. It was a trough of the cycle because they overproduced. So we're going to think about that a lot differently in terms of like, we're not really thinking about weighted average cost of capital. We're looking at the balance sheet to discern solvency risk more than we're worried about return on invested capital exceeding weighted average cost of capital in that thing. Because we're not in the hold forever game. We're in the hold for double, triple game because we're in very cyclical businesses. I found that we've come into an environment. I was telling Professor Shane, my new nickname for him. I hope they all don't start calling that. But that a lot of value investors have gotten away from their knitting because we've been in this aberrational environment, backward-looking environment called ZIRP, zero interest rate policy, for over a decade. And I was telling Professor Shane, I said, like, forget about me making you money. Let's say we ran an experiment. And you give me $10 million and you say, Tom, rather than doubling this money, I want to see if you can be fully invested and lose 90% of the capital in the next 24 months. I say, no problem, Professor Shane. This is a walk in the park. All I have to do is buy a basket of 20 companies trading above 10 times sales and losing money. And every single decade for the last 120 years, if I had bought that basket, pretty much guaranteed I could lose 90% of your money over the next 24 months. Except for the last 10 plus years in the zero interest rate environment where that actually outperformed the S&P 500. So all these cerebral value guys couldn't figure out because they were buying based on ratios and they were buying cheap for a reason and no clear catalyst. And they have all these cerebral explanations as to why what they're doing, but it's not working. So they've all capitulated, okay? So now they're all growth investors masked as value investors at the exact wrong time, just as we're going through the regime change, in case you guys missed what happened in the last few weeks with software and tech. And so they all read this book by Thomas Phelps. I'd recommend you read it, 100 to 1. How to make a 100-bagger in the stock market. It's like 30 years old. So now they all parade around and they're like, oh, I buy great businesses at good prices. I was like, oh, well, good for you. You don't have permanent capital though, so good luck with that. Because the minute they miss earnings, that great business at a good price becomes a good business at a horrible price and you're out of business. But okay, you read this little book and now you've changed your whole philosophy that has worked for a century, because you're going to chase the latest shiny object because you're trying to figure it out. So they're all buying these high return on invested capital businesses and they're willing to pay high multiples. and they pretend to be value investors, but they're growth investors. And then when they miss a quarter, they're toast. So everyone shifted to that one side of the boat. What no one's been doing is buying Albemarle at $58, buying Boeing at $135, buying, Alibaba at 100, then at 80, then at 60, and having an $80 basis. Buying PayPal at 60 and now at 40 and having a 55 or 53 or $51 basis. Buying Intel at $18. They missed all of these opportunities of a century. Buying Vornado at $13. Best office buildings in New York City went to $43 in 10 months. Buying Rolls Royce at $3 went to $8, now it's $15. Buying ExxonMobil during COVID at $33. Buying Wells Fargo at half a tangible book at $25. This is what we do. So that's not going to be, I'd say the number one screen you could run is common sense. Is this business going to be here 10 years from now? What's it going to look like? Avoid businesses that are going to be disintermediated or potentially disintermediated by AI. Cost the AI beneficiaries, which is AKA every other business than anyone in the AI business, because as they apply AI, their margins will expand, less labor, more productivity. And you'll have an opportunity to make a fortune in what's going to be one of the most productive 10 years of humankind to date. But if you're betting on which one's going to be the magic wand, gamble, you might win, you'll wind up like Ron Barron. Gamble, you lose, you become a fireman, which is a great career, but it's not investment management. So, yeah.
Awesome, and thanks for coming out here. Just had a couple of questions. The first of which is that I understand that you're often looking at performing grade or just like good companies with good balance sheets. I'm just curious if you've ever invested in kind of like a good company, bad balance sheet situation, like more or less like a special situations approach at all.
I mean, if you're going to do that, you have to kind of buy the debt. And that only happens like once a decade. So you'll buy like a durable business where the equity might be wiped, but you're buying the bonds at like 40% of par. In which case you get a double and a half, and you're kind of senior protected. So, but that, happens in 2009. That happened to a lesser extent, a little bit in 2022, a little bit in 2012. You got to wait so long for you spend your whole life hoping the world ends so you can make a little bit of money. There's much easier things to do in life. Sure. Like just buy good business at great prices. Yeah. Try to, if the balance sheet's too shaky, you generally want to avoid the equity. And I would always assume you have to have confidence to outperform, but you have to be humble and know that there are things that you can't know that you can't know. It's like what you don't know that you don't know, which is why it's like you don't put 100% of your net worth in one idea, triple lever long, okay? You have a portfolio. It's like, wow, he's concentrated 8 to 12 companies. Why? I know, if I had 100% certainty, why wouldn't I be in 1 or 2 companies, right? Because there are things that I can't know that I don't know. So another filter that we run is if any one of these positions went to 0, would the other 7, 11 positions not only make it up, but make it up and then some in order to outperform and be valuable to my clients? And the answer always has to be yes. So A, the expected value of the remainder of the portfolio has to be dramatically higher IRR than the S&P 500 net of fees. And we got to account for, it could be a situation what I don't know that I don't know. So one could get wiped out. Be like, how would that ever happen? Yeah, an asteroid hit their whole factory. Why didn't I think of that? Yeah. I don't know. I missed that movie on Netflix. I didn't know the asteroids could hit factories, but apparently other people figured that out before I did. So it could happen.
No, absolutely. But just curious. And I guess the second one too, just your thesis on the SaaS-pocalypse. Just curious. Do you think it's a re-rating or
the what apocalypse?
The SaaS-pocalypse.
SaaS-pocalypse.
Yeah, the SaaS-pocalypse.
I talked about this in the podcast last week. I guarantee you someone's going to make a fortune on this. It's not going to be me, but I know there's a pony in the pile. The only thing I'm a little worried about is that people kind of want to buy the dip. And, the greatest opportunities I've been in at are when people are like, it's over for good. And I don't think people are there yet. And they might be, honestly, they just might be great businesses at good prices, but it's sifting through the rubble. It's like, okay, the obvious ones, CRM, Adobe, ServiceNow, maybe SAP to a lesser extent. I've tended to avoid software just because I'm kind of a Buffett disciple and like a, bit of a Luddite. But I could never get fully comfortable that the moat couldn't be breached. It's like, if you can create the software, why can't someone else copy it? Now, they have network effects, so there's a moat in that. Look what Microsoft did. And Buffett missed Microsoft, so he'd be worth $800 billion instead of $400 billion, but then he gave away $200, but he's still worth more than Musk. So, and he doesn't have the sales ability Musk has. I mean, Musk, it's amazing what he's been able to do, the master illusionist. So, great question. Anything else? Any other questions? Yeah.
How do you talked a lot about like longing, but how do you kind of approach shorts?
Shorts are tricky. So number one is never go short a stock and announce it publicly. That's like rule number one. Rule number two, don't forget rule number one. But we run a concentrated portfolio, 8 to 12 companies. That makes up 85 to 90% of the portfolio. Then we have this derivative bucket, 10 to 15% that we use for long-dated overlays on the core positions to get excess returns without drawing major leverage. In English, long call spreads, whatever. And then we also use that bucket from time to time if we think the market is dramatically overvalued, but none of our positions are fully valued where we want to harvest it and build up some cash into the weakness. We will use that bucket to do put spreads on indices, sectors, or individual companies, but we're never taking unlimited exposure, either in options or in shorts. It's always quantified to 1, 2, 3% of equity in that regard. But we've had some good ones, and they've created a lot of capital that enabled us to buy more at the bottom, which was really nice. That's my best advice. Quantify your risk, and there's value in that, but it's not. It can't be a full-time business because at the end of the day, the markets go up 70% of the time, and you're better off buying great business at a huge discount to intrinsic value, so you're not so worried about the fluctuations of the market. Yes, if the market goes down a lot, your stocks in theory should go down. But what I find is, and I was just talking with Professor Shane, is that our filter creates us buying defensive stocks before volatility comes up, not because we're bearish or we're taking a prediction on the markets, because those are the ones falling in our filter like, wow, this is a high quality business with a reasonable return on invested capital above its weighted average cost of capital, and yet the stock price is down 70%. Why can't you give away a consumer staple stock last fall? Why can't you give away a healthcare stock last fall? So what were we pounding the table on? Healthcare, consumer staples, and we have a lot in them. So it's like, okay, we have a relatively more defensive than normal portfolio, not because we are predicting a crash, although I think we'll get a lot of volatility in this year, midterm election, blah, 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 all the empirical data. But it's not because we took a view and then hope we're right. It's because that was what was available within our framework, and it's telling us a story of what might be to come versus us guessing what's to come and then making a bet on that guess, double down on fantasy versus why is this showing up? Oh, maybe we're due for some volatility. Yeah, and like while that software apocalypse was going, consumer staples had the biggest start to the year since 1992. It was up 11% in the month of January. Defensives. So that's helpful. Other questions? You got me for another 20 minutes if you got a couple others.
I had a question.
Yeah, Ethan.
I was wondering, like, what is your kind of take on like the consumer spending market right now? Because I know, like for discretionaries, for example, like VF Corp or like PayPal is indirectly tied to consumer spending. Yeah. I guess like with the state of the K curve right now, I guess like what's your kind of view on that?
Yeah, this is a really super question. As a matter of fact, so consumer sentiment is at multi-decade lows, actually. Now we just got a reading last week highest reading in 6 months. So it's starting to come off the mat. But consumer sentiment is lower than it was during COVID, lower than it was during the great financial crisis, lower than it was during the tech wreck. So I think there's a huge amount of leverage in as that starts to improve, because it really can't go much lower. Like it's kind of crazy. It's like end of days sentiment. People are like, I'm miserable, and then they're like, you can't get a reservation at a decent restaurant. So there is a K curve to that, but I think you got a couple things coming down the pike. Number one, we are in an easing cycle. So we have a 71% chance of a cut in June when Warsh comes in, and when he comes in, he's going to start to he's going to resume quantitative tightening. By the way, we're in quantitative easing right now, again, and then he's going to cut till the cows come home. So that's going to be very, very constructive for cost of capital. That's going to put a lot of people in. Then you've got tax refunds going up 50%. They're coming soon. So that's going straight to restaurants, straight to vans, hopefully straight to vans. Papa John's, we'll see. But I put a chart in last week's article overlaying PayPal's stock price to, I think it was UMISH consumer sentiment over the long term. And it's like, if we get any recovery in consumer sentiment, which we do every single cycle, I always say, the good news is the end of the world only comes once, and if it's now, you don't have to worry about your stock portfolio. But if it's not the end of the world, there's an unbelievable opportunity to take advantage of right now. So that's asymmetry, because if the asteroid hits, you could care less, and if it doesn't hit, you can make insane amounts of money. So bet on the latter, former doesn't matter. And I think that's exactly the status that we are in right now. If you look at all these restaurant stocks, if you look at some of the stocks like Nike, like VF Corp, some of that was pulled forward from COVID, some of that, there's a lot of that in, but I do think this is going to be the year, maybe the 18 months of Main Street. So the economy is going to run exceptionally hot, and it's not going to be reflected in the stock market because the stock market is overweight Mag 7. So people are going to feel good. They're going to be spending. A lot of these stocks under the surface are going to be doubles and triples. The indices are going to be underwhelming, mid-single digit returns. And on that basis, Besant was out talking about 4 to 5% real GDP, 7 to 8% nominal. I mean, from his lips to God's ears. But I think it could be something like that. And if you look at Trump's first term, Main Street did a lot better than Wall Street. Wall Street was very volatile. It did okay, but real wages went up for Main Street people. People felt better. There was a much better consumer confidence during that period. And whether you like Trump or not, it's just his policies are financially driven. So you could say, well, everything shouldn't be financially driven. Some should be socially driven. That's for another classroom. I don't comment. I'm here about making money. So I would say that the policy environment is to run the economy super hot. And now he's got the players in place to make that happen. And that's what's going to drive consumer confidence. And that's where you're going to see huge leverage in the prices of consumer discretionary that are left for dead right now, whether it's VF Corp, Nike, maybe Lulu to a lesser extent. That's why I'm kind of channel checking with the cool kids here. And then the restaurants, like, do you guys still eat at Chipotle? The stock's saying that no one goes to Chipotle anymore. I went there, I tried this red chimichurri sauce. Guy plays golf at my club. I mean, he seems happy all the time. So, like, what's the deal? Is there anything wrong with Chipotle? Are they still skimping on the beef here? You gotta arm wrestle them. I said more beef. I mean, I think they're going to be okay. That red chimichurri sauce, I thought was pretty off the charts. Although my kids don't go there. They want to go to In-N-Out. They want to go to, oh my gosh, my daughter just won the Golden Cup at Chick-fil-A. She's getting free Chick-fil-A every week for the next year. Did you guys know they had that? She's a Chick-fil-A fanatic. She bought 2 cups yesterday, and maybe I'll cover it on the podcast. She was like, she opened the first one. It was a failure. And she opened the second one. She got the gold cup. She starts jumping. The manager comes out. picture. She's getting free Chick-fil-A for the next year. I mean, I thought that stuff was, I didn't think that actually happened. It's like Willy Wonka and the Chocolate Factory. I've never seen an 11-year-old so happy in my life. So that's that. Other questions? Oh, I'll give you a life lesson. You're going to think you're too poor to have kids. Well, a lot of you aren't poor, actually. It's USC. But you'll make enough money here's my suggestion. Have more kids than you want to have. Because when you get to your 40s and 50s, you're going to realize that's all it's for. In your 20s and 30s, you're like, oh, if I just become VP, if I become, EVP, if I become COO, I'll be happy. And yeah, you will. You'll actually be more happy if you're more successful. I'm not going to lie to you. But you'll be more fulfilled if you have a big family. So have more kids. I had 2. I'm very grateful for them. They're incredible. If I had to do it all over again, I'd probably have 4 or 6 or 8 or whatever. Knowing, if I could, with hindsight 2020, I'd been like, dude, you can have 40. Like, let's go. I mean, that would be a big Christmas party. So more kids is a good thing. Anything else? Yeah. Yeah, and I don't have some dystopian view like Elon Musk. He's probably right about the population thing, so that would be helpful as well. But
no, I agree with that. So you've got some good examples of really well-performing investment ideas that paid off. How do you think about like the ones that don't work out and when to pull the plug?
That's a good question.
We all make mistakes. When is it the right time to say, even though this has gotten cheaper, the company's not going to recover, the investment thesis is not playing out?
Yep.
Time to look for another opportunity.
Yeah, I mean, usually it's a function of time if you underwrite it properly. But I mean, I'm dealing with one right now with PayPal. Okay, so we had 59 and change basis, and we've spent the last 2 weeks buying stock until our fingers bled, and now our basis is in the 55s and probably going to the 53s over the next few days. So, like, that's the asteroid hitting. Like, I wake up one morning, I'm supposed to be on TV, and like, because it's East Coast, so 6:30 9:30 Eastern time, I'm doing it remote. 6:30, I wake up at 5, and I see like, a bunch of texts, blah blah blah. PayPal, S the bed, for lack of a better word, since we're on video. On my podcast, I do curse, so any of you who are into cursing, you're going to love the podcast. So I mean, like, I couldn't have predicted that they were going to change the CEO and they were going to do weak guidance, but that's kitchen sinking it. I understand why they did. So after you get over the shock, and then I had to go on, and they're like, oh, by the way, you're not talking about this and this. We want you to talk about PayPal. I'm like, perfect. I'm like, haven't even made the coffee yet. Okay, so but if you see that Yahoo clip, it's probably worth watching, because I quickly did an analysis of what Enrique Lores did at HPQ, Hewlett Packard, which if you think PayPal has no innovation, you're going to love HPQ because they're even worse. Okay, but he got in. He was announced CEO in 2019. Again, a month or two before he got in, the stock crashed down to $10. He got in, peaked at $37. He bought in 37% of the shares over the next few years. So you could have made a 3.5 if you weren't greedy. If you were greedy, you wrote it back down. But and that business is 1/10 as good as the optionality in. Anyone play poker? Yeah. So in poker, you look for something called outs. You look for a lot of options, ways you can suck and still win. That's what I saw in VF Corp. That's what I see in PayPal. That's what I saw in Alibaba. That's what I saw in Intel. I'm looking for ways that I can be wrong and still win. And that's exactly what happened. I mean, I'll tell you another example that I always give was Range Resources. I think this was like 2018. Stock had fallen from 90 down to 11. It was one of the largest natural gas producers in Marcellus Shale. And I estimated the intrinsic value, the proved and unproved reserves, was worth $65. And so we built a position, and like, it was like magic. It immediately went to $18. Okay, I was like, man, I'm smarter than Isaac Newton. So, and then it hovered around there, it started going down, and then COVID came. And during COVID, it went from 18 down to $1.65. but nothing changed in the thesis. The proved and unproved reserves were still worth 65. It was the wrong time in the cycle. The balance sheet was better than all their peers. So we bought a ton more, and we brought our basis down to $4.10. Stock is $33 today. It's probably going up to probably 70 or 80 over the next few years. So the question becomes, when you're wrong, is, what bothers me about PayPal is not the fact that we're going to own a lot more of the stock and then a lot more because they're going to buy in. We're buying from the weak hands, and then they're buying from the weak hands, which makes our share bigger. So we're getting like two bites at the apple. The biggest risk you run if your underwriting is sound and they don't get hit by an asteroid is your IRR goes down because you lose a few quarters of transition. And so that was a risk with BABA. We made it up by doing the call spreads at 7x on the spreads, double on the stock. We still own every share of stock. And that'll keep going. And we're doing the same thing with PayPal. So we're going to wind up sending a thank you card for Alex Chris for sucking so bad, because he enabled us to make more money than we would have made if he didn't do it. And I'm being hard on Alex because I think actually Alex is going to not get any credit but be responsible for some of the great things that Enrique takes credit for and spikes the football. Just like Lip Bhutan at Intel is spiking the football for Gelsinger, who did it for 4 years. It's just the board of directors is no different than the day trader with the $30 Robinhood account. They saw the price go down. They wanted to keep their $300,000 a year coming in for going to 4 meetings. That's a good job if you can get it. So they just axed him, put in Enrique. They did the same with Gelsinger. Gelsinger would have been fine. Lip Bhutan's amazing. Lip Bhutan, Bracken Darrell had a 26-bagger at Logitech. Lip Bhutan did Cadence Design Systems, which was also down 80-something% when he came in. He had a 68-bagger. So if you put in $1 million, you made $68 million over a decade. So I like Lip Bhu better than Gelsinger. But Trump didn't originally, which was another problem. But we get through it. So anything else? Yeah. Go ahead.
Similar to the last question, but what's your worst stock you've ever purchased and what you learned from it?
The worst stock I've ever purchased. When I was 17 years old, I was working as a golf caddy. And this guy named Warren Feldman was like the richest guy in the club. And he ran this company called Total. And he sucked at golf. Like, it was like, you didn't want to caddy for him because the round would take 5 hours and it was so much work because like he took 10 shots a hole. But you did want to work for him because he tipped better than everyone else. And he was like the wealthiest guy in the club. So, I was curious back then, and I was like, what's your company? How did you become so successful? Blah, blah. I was curious, right? So he's like, he said, it's called Total. And I was like, is that a public company? He's like, yeah, it's a public company. I'm like, oh, okay. So, man, this guy's so rich. So I go home. I literally put like all my caddy savings into this stock. I was kind of right, but I was wrong. I actually mistakenly bought Total Energy versus Total. And over the next 2 years, I subsequently blew through all of my caddy earnings for that summer. So I learned a mistake because I was, I think that's a perfect example of Peter Lynch says. People will spend 2 weeks of their life perfectly planning their vacation to get the best deal, to get the best itinerary, to have every detail worked out so they can save $500 and have a great experience. And then in the same afternoon, they'll hear a stock tip on the bus, and they'll go home and they'll put their entire life savings without knowing anything. And that's just human nature. And you either want to be at the effect of it or benefiting from it. And what I'm trying to communicate today is hopefully you'll be benefiting from it. And if you figure out how to benefit from it, you'll have everything you could ever want in life and more, and the funds to have 40 children. So, that said, all right, thank you.
And we're back. Quote of the week: you'll do better if you have passion for something in which you have aptitude. If Warren Buffett had gone into ballet, no one would have heard of him. That's from Charlie Munger. I think that's right. And that's why we often recommend to people, read The Intelligent Investor by Ben Graham. As I said in the presentation to the students, if the light bulb doesn't go off, it's okay. Go be an entrepreneur, build a business, and get wealthy that way. This one is their genetic characteristics that make great investors that in many ways are the opposite characteristics that make great entrepreneurs. Entrepreneurship is about massive action equals massive results. Great investing is about massive inaction. Have the proper framework, set it, and let it compound, doubles or triples in a few years, rinse and repeat. So that's that. Want to thank all the folks who have been sharing the podcast. That's one of the reasons we were at USC Marshall School of Business. That's all we ask each week. If you're getting value, share it with one or more friends that you care about. And we've had a lot of people ordering hats. It must be all the Cooper Standard millions that have been made here in the last few years. And we had another boost on Friday. The stock was up 30%. I mean, we got into that thing May 2022, just over $5. It immediately went to $3.50. We bought more, and now it's at $45 and going higher over time. So we're pretty exciting. I'm sure some of you have trimmed a little bit of profits, but we're going higher over time, and we're pretty excited about that. So send in your pictures. We'll get you on the website. And I know we got a lot more coming in this week, and that's the easiest way to share. Put on your hat, people will ask you, and share the good news and become part of this awesome wall of fame that just keeps getting bigger every single week. Super excited. All right, let's get down to data. So opinion follows trend. Stifel was out on today talking about Cooper Standard, and they took their price target from 43 up to 61 because it's already at 46. So here we go. They've been strong proponents for a while. They do some great work over there, and you can get a sense of what they're looking at. The net new business wins are going through the roof. 23, 176 million, 24, 181 million, 25, 298 million. Management expects 2026 net new business wins to exceed 400 million. Which is just mind-boggling what they're doing. And that's what we talk about, operating leverage. And that's why we love turnarounds and are known as Turnaround Tom. Here we go, ladies and gentlemen. Next, this is the most obvious catalyst to halt the AI rotation. Bank of America's Hartnett says a CapEx cut by an AI hyperscaler is the most obvious catalyst to reverse significantly the market's rotation from AI awe to AI poor, suggests strategist Michael Hartnett, pointed to wildfire AI disruption ripping across sectors, including insurance brokers, wealth advisors, real estate services, and logistics. They note that India tech was the first AI disrupted sector and the first quarter with no bid yet. The bigger picture notes major rotations underway, correlation between Japanese yen, blah, blah, blah. They reiterate a structural rotation from U.S. large cap growth to small cap value, from U.S. equities towards emerging market equities. Tomorrow's newspaper today, we were pounding the table all last year. This was coming, and it's come in spades, and I'm super excited to see it here year to date, what's happened, and obviously last year for everyone who was with us for that. At the same time, they reiterate, okay, we got that. Under the Great Rotation, strategists believe the next secular leaders are likely to be emerging markets and small caps, and U.S. exceptional gives way to global rebalancing, and anything but dollar trades gain traction. There we go. Okay, secular leaders, emerging markets, stocks, and commodities. Here we go, ladies and gentlemen. Best opportunity since 2001. We've been showing this chart for over a year. Here we go. And it has only begun, which is even more exciting. Secular leader equals small cap stocks. U.S. large cap growth versus U.S. small cap value. Look what's happening, ladies and gentlemen, just like in March 2000. That's why you're seeing the Palantirs of the world get hit. All the software stocks get hit. They'll get their bounces, but the trend is your friend, and this is what is happening. Value, small caps, international. We have been pounding this. Just listen to any episode for the last 15 months, and you were ready for this action, and here it comes. And it's going to be multi years, ladies and gentlemen. And that's why we're positioned the way we are positioned. Emerged secular leader, emerging market and China stocks. This is unbelievable. After all the China stocks are up double and triple, now they're calling it a secular trend. And you know what? We need exactly that for them to just get everyone into this trade. And when Bob is in the high 200s, low 300s, they will create the liquidity for us to help people out. No one wanted it at 60. Everyone's going to want it at 250, 300, and we will help them out. Hyperscalers are forecasted to spend $675 billion, up 63% year on year in 2026. That hurts free cash flow. That hurts buybacks. That hurts margin. That hurts EPS over time. Here comes the banana peel part of February. So I guess end of month is supposed to be weaker. That's from Carson. We shall see. U.S. versus the rest of the world. This is now breaking down. The U.S. exceptionalism trade has broken below this 16-year channel. Weak dollar trade is going to persist for a few years, and we are positioned. Emerging markets bonanza. Capital flows into emerging markets surged to the second highest in over 2 decades. Emerging confidence, everything but U.S. Surge in blowups near highs. Okay, we got that. Relative U.S. tech versus global tech also now rolling over like we saw in the early 2000s. CapEx as a percentage of cash flow from operations has now gone over 60% and is expected to go over 90% by the end of the year. How could you own these things right now? We are going to have probably the opportunity of a lifetime to own a bunch of them this fall, when everyone is in despondency and you can't give away the AI trade and everyone says it's over, and we will be off to the races. International stocks draw the most inflows this year. Flows into developed market equity funds, more of the same that we've been talking. Magnificent Seven, a share of U.S. net exposure. This is going to get degrossed quickly. Energy breaking out, short interest at all-time high. What else do you need to know? That's our National Oil Well, Varco, and Comstock. Implied allocations to commodities. There's still so much more exposure to be had there. Average annual U.S. dollar return of equity portfolios invested in economies with valuations above and below the sample median rebalanced annually. Valuations matter. When you invest at good prices, you get good results over time. And the opposite is true. This is the incentives on automobiles has been going straight up. We'll see this tick up more. The affordability is improving as prices have sidelined for the last 4 years. So that's positive. Trump is doing some things with environmental that'll make prices come down even more for auto buyers, which is going to help Cooper Standard in its final few legs. We're super excited over the next 2 years. Next catalyst would be the refinancing, which we're excited to hopefully get some news. They alluded to in the conference call. We'll talk about that. Capital intensive versus non-capital intensive. That's from Goldman Sachs. Magnificent Seven total returns year to date. Every single one of them is negative, ladies and gentlemen. People said we were crazy. Now they're seeing it in spades. Microsoft down 17% year to date. Amazon down 14%. Tesla down 7%. Apple down 6%. Meta down 3%. Google down 2.3%. Nvidia down 2.0%. And Palantir down a lot more than that. Credit Manager survey of manufacturing sales implies plus 4% GDP growth. This is going to be the year of Main Street, not Wall Street. That's exciting for the type of businesses that we own on Wall Street. So we'll figure out how to take advantage of that. S&P market cap versus equal weighted realized correlation has now dropped, becoming a stock pickers market. Bank of America Industrial Momentum Indicator turning up when Besant was talking about 4 and 5 real GDP growth percentage and nominal GDP growth. They are going to run this thing hot into the election. So beware. That doesn't necessarily bode for stock market index gains, but it does bode well for real economy company gains, i.e. the unmagnificent 493, because the indices are still overweight tech, which is going to have much more subdued returns for this year. Hopefully we will have an opportunity to buy them if it gets to a despondent state later this year for those high-flying stocks. Total put-call ratio is at or near extremes you see towards bottoms. Maybe it goes a little bit more, but that's interesting to see, especially so little bit off all-time high. But these software stocks are getting absolutely shellacked. I saw this guy who is an investment banker in that sector, and he literally looked like he lost his dog this week. I mean, I couldn't, he was just not in good stead, and understandably so. A lot of these guys were super levered long into these high-flying software stocks and AI trade, and they're just completely roasted. Real stuff is leading the stock market higher: energy, materials, staples, industrials, aka our portfolio, and communication services and IT are lagging. U.S. versus world, ex-U.S. equities since 1995. Really doing poorly this year. International doing great. And U.S. versus international spread. It shows what happened at the peak, and now we're going to see some international outperformance. Emerging markets growth expectations are soaring. What we talked about last week, by the way, with the Eurobond, I would imagine they're going to get that through without a unanimous vote, and that's probably going to create a lot of international confidence as well towards the end of the year, with some bumps along the way before they get that resolved. U.S. equity market internal pricing of economic growth. This is underweight. New vehicle sales, millions of sales. As you can see, ladies and gentlemen, this was the cycle we were talking about back in 2022 when we got involved in Cooper Standard at $5 and change. So we're not even close to peak what we saw the last two cycles, and our population's gotten bigger ever since. So at 17 million, let's see what the earnings power is and what's the multiple on that earnings power. We think they can earn $10 this cycle, and we don't know whether they'll get a 10 multiple, which would be a trough multiple, or a 20 times like they did in 2017 when it was a $146 stock. But we're going to participate. We'll trim a little bit on our way up, but just to be responsible portfolio managers. But we're going to have a huge slug on well into the triple digits in our view, and we're super excited about that. Tax refund season sees a significant pickup in U.S. equity fund inflows. So we should start to see that now as the refunds come, and the refunds are going to be bigger than ever. That should also help consumer discretionary a bit. Record bearish flows in the software sector. This is due for a massive bounce, whether it will be a sustainable bounce or a counter trend bounce. I will leave it to you folks who trade in software and think that you have an edge as to whether they are disintermediated or not. I think it is a little bit of hysteria. I think there is a pony in that pile, and I'm happy to watch you guys get rich finding it, but we are not going to participate in that. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Some of the key headlines of the week. Alibaba unveils major AI model upgrade ahead of DeepSeek release. Quen apps campaign attracts over 120 million orders. There goes Alibaba. Lunar New Year gives luxury brands a chance to win back big spenders in China. After years of decline, the Chinese luxury market is showing signs of recover, aka Estee Lauder, aka Canada Goose. The goose is loose. Moving along, Z touts super large China market as key to boost local demand. The toll taker is Ali effin Baba. U.S. car makers spooked by Chinese rivals gaining foothold in America. Possible shift ahead of Trump's planned visit to China in April. That's going to be bullish for Baba when they shake hands in April. The Estee Lauder company unpackages 3 brands for sale, according to sources. That's the beauty of a turnaround. You need a brand that has a lot of outs And that's what we have with VF Corp. That's what we have with PayPal, Braintree, Venmo, Buy Now, Pay Later, all the beautiful things that Enrique Lores is going to realize that value for us. We are going to make so much money on that. This is Alibaba Part 2. Not only were we buying a ton of stock in the hole, bringing our basis down into the 53s, we were buying a ton of options, and we are excited. And that's where we made so much money on Baba. Advance Auto swings to a profit amid store closures. Same store sales are up, ladies and gentlemen. Shane O'Kelly is hitting on all cylinders, delivering exactly what he promised he would deliver. This was super excited. I was a little nervous on this one going into earnings. The stock was up big, and it followed through. Amen. Hallelujah. Here we go. Energy is firmly in a rotational bull market. That was like our biggest surprise of the year. You couldn't give away energy going into the year. Now everyone is starting to want it. We love it. And it's just getting started. This is going to be multi-years. Trump green lights more oil and gas investments in Venezuela. Let's go, Varco. Here we go. As tech struggles, dividend stocks step back into the limelight. What have I been saying? Easing cycle, buy dividend payers. Staples, baby. REITs are going to come back like nobody's business, including Crown Castle. Okay, hang in there, ladies and gentlemen. The staples are getting paid, and that's what they're talking about. Our Pfizer is kicking butt, and more to come. Average tax refund is up 22%. Besson says what filers can expect this season. That's good for discretionary. How Congress plans to take on the housing crisis. They're doing a number of things, pushing cities to build with the federal funding, streamlining environmental reviews, manufactured and modular homes, expanding mortgage access, and more to come. Volume opens the floodgate stock market and sentiment results. Our article of the week, Cooper Standard and Baxter. Cooper Standard closed out 2025 with a textbook quarter of disciplined execution, playing the hand it was dealt and focusing on what it could control. Management called it the strongest operational year in company history, and the results back that up. I mean, ladies and gentlemen, go back to May 2022 when we put this out to the podcast listeners at $5 and change, and then for the first time publicly on Fox Business, May 6th on the Claimant Countdown. You can find it in the YouTube channel. And unbelievable. Bought in the fives, dropped to 350, bought more, and this thing has just been straight up. And then everyone else would get impatient here. It got up to 22, then it dropped back down to 10. Everyone was getting puked out right here on big volume, and then boom, straight to 45. And we've got more, babies. I'm telling you, this is super exciting. It'll consolidate some of this, but it's going higher over time. Management called it this. Okay. Despite the Novelis aluminum plant disruption, which idled 40% of North American sheet supply and halted F-150 production, Cooper Standard's number one platform, the key drivers that move the needle continue to trend in the right direction. Adjusted EBITDA rose 16% to $209.7 million, reaching the high end of guidance with 100 basis points of margin expansion to 7.6%. Net new business awards, the number one indicator of future growth, totaled $298 million, the highest level since 2019 with 74%. Tied to EVs, 20% cost per vehicle uplift, and hybrids, 80% cost per vehicle uplift. Free cash flow reached $16.3 million, making the third consecutive year of positive free cash flow. Most importantly, the reason the market sent shares up over 30%, 2026 guidance implies another major step higher. Adjusted EBITDA is expected at $260 million to $300 million, plus 33.5% at the midpoint, with margins reaching the long-awaited 10% threshold. New business awards are expected to exceed $400 million, up 34% year on year, with many already in hand. Free cash flow is expected to reach $50 million at the midpoint, more than tripling 2025 levels. What makes this even more impressive is that the entire outlook is once again predicated on the Mortician's forecast for production volumes. Guidance assumes North American production declines to 15 million units and global production falls by 0.6 million units or negative 0.9%. The fact that Cooper Standard can expand margins at that rate and delivered improved results in a flat to down production environment despite being a leveraged supplier speaks volumes about the heavy lifting management has already done and the groundwork laid over the past several years. And when, not if, volumes normalize, Cooper Standard will be in the strongest position it has ever been in to capitalize and deliver. The fact of the matter is that every U.S. auto cycle over the last 40 years has peaked between 17 to 18 million SAR. Today's Mortician's production forecast sits at just 15 million units, ladies and gentlemen. Keep in mind, the population was 1/3 smaller in the 80s when it peaked well above 20 million units. So here we go. U.S. population more than 30% higher than prior cycle peaks, with over 70 million millennials entering prime vehicle ownership years. What else do you want to talk about, ladies and gentlemen? Record high average vehicle age, 14.5 years. That not only helps Cooper Standard, that helps Advance Auto Parts, which we love. Strongest growth in licensed drivers in more than 4 decades. This is exciting, unless one is willing to ignore these structural demand drivers and what history has shown in every prior cycle. Mean reversion is inevitable. The beach ball of demand can only be held under for so long. Keep in mind, our original thesis on Cooper Standard was a recovery in North American ICE production volumes. Since then, we've picked up the added bonus of 2 structural tailwinds that were never part of the original underwriting: hybrids and aggressive global expansion by Chinese OEMs. Consumers are voting with their wallets, and the shift toward hybrids over EVs is abundantly clear. Hybrids happen to be Cooper Standard's sweet spot, requiring roughly 80% more content per vehicle and delivering structurally higher margins. At the same time, Chinese OEMs are launching aggressive global expansion plans and winning massive market share in the process. Cooper Standard expects this to translate into a tripling of sales to Chinese OEMs over the next 5 years at attractive margins and with little to no incremental capacity investment required. This unexpected twofer of demand drivers was never embedded in our original model, which makes our estimate of Cooper Standard returning to its 2018 peak price of $146 look increasingly conservative. We'll see on the multiple, okay? So if they earn $10 a share and they get a trough multiple of 10 times, you got 100. If they get a peak multiple like they did in 2017, you could have a $200 stock. And that's pretty exciting. While volumes catch up, the near-term catalyst and next leg higher will be driven by a global refi. We estimate successful refi could generate $34 million of annual interest expense savings, or roughly $1.90 per share. Amen, hallelujah. Applying conservative 10x trough, 20x peak multiples to those savings alone implies $19 to $38 per share of incremental value, or 42% to 84% of today's price. Here's what management had to say regarding the timing of a refi during the earnings call. Quote, "We certainly would prefer to get something done prior to the first lien and third lien notes coming current. Those milestones are middle of May and middle of March, respectively. So if you think about it in that kind of time frame, certainly we don't want to have the added pressure of the notes coming current. Based on that commentary and assuming they are successful, we could see news on the refi in the coming weeks." So despite being a major winner from our initial cost basis, our confidence in CPS continues to move higher as secular drivers remind us that this story remains in the early innings. Cooper Standard reports, there we go. So you can go to hedgefundtips.com. While you are there, click on terms. This is all opinion, not advice. And you can go through all of the key things we've highlighted and starred in the earnings report and slide deck from the company and earnings call transcript. Here are the 10 key points. Number 1, revenue totaled $672.4 million, up 1.8% year on year in Q4, driven by a $14 million FX tailwind that more than offset a $3 million volume and mix headwind. This brought fiscal year 2025 revenue to $2.74 billion, up 0.4%. Ahead of prior guidance, 2.68 to 2.72, driven by a 12 million FX tailwind and a 2 million volume and mix headwind. 2, gross margins in the quarter were 10.4%, minus 200 basis points year on year, pressured by significant production disruptions on Cooper Standard's largest platform, F-150, and the Novelis fire. For fiscal year 2025, gross margin still expanded 80 basis points to 11.9%. Adjusted EBITDA totaled 34.9%, 5.2% margins, minus 300 basis points year on year, bringing fiscal year 2025 adjusted EBITDA to $209.7 million, 7.6% margins, up 100 basis points year on year, reaching the high end of prior guidance of 200 to 210 million. Management expects fiscal year 2026 adjusted EBITDA of 260 million to 300 million, plus 33.5% at the midpoint, which translates to adjusted EBITDA margins reaching or exceeding the all-important 10% level. Keep in mind, this margin expansion is based on an overall decline in volumes, setting a low bar for potential upside surprises. 3, Cooper Standard won 69.5 million of net new awards during Q4, bringing fiscal year 25 new business awards to 297.9 versus 181.4 in 2024, up 65% year on year. 74% of total new awards during the year were tied to battery, electric, plus 20% cost per vehicle, and full hybrid plus 80% cost per vehicle platforms, with 51% of total awards attributable to China OEM platforms. Management expects to win 400 million plus in net new awards in fiscal year 2026, up 34% year on year, with many of these awards already in hand and a higher mix tied to Chinese OEMs, which typically move faster to production. Cooper Standard expects to realize revenue contributions materially quicker than the traditional 2 to 3 year ramp seen with Western OEMs. Cooper Standard also secured several significant supplier recognitions during the year, including GM Supplier of the Year, Ford Supplier of the Year, and the key Toyota Excellent Achievement Award, #1 global leader in hybrids with 50% of total sales. 4, Cooper Standard believes it is strategically positioned to support Chinese OEM growth and their aggressive global expansion plans, expecting to grow and gain share alongside them. Management expects to triple sales to China OEMs globally over the next 5 years, while doubling overall APAC regional sales over the same time frame. China OEMs currently represent 36% of revenue in China, which is expected to grow 60% by 2030, with total China revenue expanding at a CAGR of north of 15%. Management believes this expansion can be achieved with minimal incremental investment, supporting very attractive ROIC and fantastic margins. 5, management delivered 64 million of manufacturing and purchasing lean and savings during fiscal year 25, along with 18 million of restructuring savings related to the salary reduction implemented in Q2 fiscal year 24. This brings total cumulative sustainable cost savings since 2019 to 712 million. For fiscal year 26, management expects 90 million of manufacturing and purchasing lean savings, along with 10 million of restructuring savings. Management has already identified well over 90% of these savings, the highest level of visibility in more than a decade in terms of initiatives already identified and in progress. 6, while Cooper Standard did not provide concrete updates on the global debt refi, first lien 613 million at 13.5 and third lien 389 million at 10.65. Management indicated the goal and clear preference is to complete this refi before the third lien becomes current in March and the first lien in May, while highlighting meaningful progress in evaluating potential paths forward, with net cash interest of 105 million to 115 million expected in fiscal year 2026. The implications of a refi are massive and could translate to $1.90 per share in pre-tax savings. 7, free cash flow during Q4 totaled 44.6 million versus 63.2 million last year, bringing fiscal year free cash flow to 16.3 million versus 25.9 million last year, and making the third consecutive year of positive free cash flow. Management expects to remain free cash flow positive in fiscal year 26, with the midpoint of guidance implying 50 million for the year, more than tripling fiscal year 25 levels. 8, CapEx during fiscal year 25 totaled 48.2 million, just 1.8% of net sales, as management continues to operate lean compared to the bloated 5 to 6% of net sales seen historically. Management expects 55 to 65 million in CapEx during fiscal year 26, 2.14% of net sales at the midpoint. And as they continue focusing on cash preservation and high return opportunities, believe they are on track to triple return on invested capital by fiscal year 2028. 9, Cooper Standard ended the year with cash and cash equivalents of 191.7 million. Its revolving credit facility of 160.9 remains undrawn, bringing total liquidity to $352.6 million. Net leverage ended the year at 4.4 times, with management maintaining its goal of reducing the net leverage ratio to 2 times or lower by 2028, not assuming a global refi. 10, for fiscal year 26, management expects net sales of 2.7 to 2.9 billion, plus 2.2% at the midpoint. This growth comes despite Mortician forecast assumptions calling for North American production to decline to 15 million units, Europe to 16.9 million units, and Greater China to 32.7 million units, with South America the lone bright spot at 3.2 million units, up 200,000, implying a global production decline of less than 1%. Here are the earnings call highlights. We green and starred the key points for you to listen and to the analysts. Here is Baxter's earnings. We haven't seen this type of sell down in Baxter since 2023, and by 2003, over 20 years ago, and by 2008, it was at all-time highs. And I think we could find ourselves in a similar position. Go to any doctor's offices, it's all Hill-Rom and Baxter and everything that they own, and healthcare demand is only going up. Yes, they've had poor execution, but they got a new guy at the helm. He's going to fix it. It's taken a little longer than expected. Hang tight. It will be fine. We love this position. And I think this will work to new highs over the next 3 to 5 years. And it doesn't have to work to new highs for us to make a lot of money. And we're going to continue to do that as we brought our basis down. We've been to this movie before. We did it with Baxter. We did it with Baba. We did it with Intel. We're doing it with PayPal. We're going to do it with Baxter. We did it with Cooper Standard. We did it with Albemarle. We did it with Exxon. We've done this over and over again. Okay. So just hang tight. That's why we like to be in businesses that have been around for 100 years. We know how they operate through cycles, and sometimes it takes an extra year, but we still make our multi-baggers. Turnaround Tom, here we go. Top 10 key points. Revenue of 2.97 was up 8% reported, 3% operational. Top consensus. So the revenue was fine, 2.83. So they crushed consensus on the top line, and prior guidance of 2.8. With growth across all three segments, this brings fiscal year revenue to 11.24, was up 6% reported, 3% operational. Adjusted EPS of 44 cents, missed consensus of 52 cents, and prior guidance of 52 to 57, with the shortfall driven by unfavorable product mix and certain non-reoccurring items. Adjusted EPS totaled $2.27, up 20% year on year when you take out the non-recurring items. 2, adjusted operating margins came in at 11.8%, bringing fiscal year 25 margins to 14.1%, up 20 basis points. This fell below expectations of 14.5 to 15%, driven by unfavorable mix and certain non-recurring items, including inventory adjustments. Management expects fiscal year 26 adjusted operating margins to land between 13 to 14%, below consensus estimates of 14.7. The most important driver of margin expansion going forward remains the stranded costs associated with the Bantiv deal, which management expects to begin tapering in 26 and fully eliminate by the end of 27. 3, the IV Solutions segment delivered solid growth in Q4, driven largely by favorable comps from prior year's Hurricane Helene impact. Management noted that underlying U.S. demand remains 10 to 15% below historic levels, which they now view as the effective new baseline. To reflect the lower demand environment, the company's taken steps to right-size its support footprint and align labor with current volumes. While the recovery is taking longer than initially expected, Baxter experienced a similar dynamic following Hurricane Maria in 2017, which took 2 years for volumes to normalize. 4, while the quarter's top-line performance benefited from a more modest net impact from the Novum IQ large volume pump customer returns, management now expects to ship an installation hold to remain in place through fiscal year 26. While disappointing, it is important to remember the product represents 2% of total revenue, and the prior generation Spectrum platform remains a strong alternative with solid demand. Management noted continued progress on the Novum solution and corrective actions, but felt it was prudent, given uncertainty around customer responses and timing, to assume the ship and installation hold remains in place for the full year. 5, free cash flow accelerated to $456 million in Q4, bringing full year free cash flow to $438 million, plus 17.4% year on year. Free cash flow is up 17.4% year on year. Management expects further improvement in fiscal year 26, driven by stronger working capital performance and the absence of certain one-time hurricane-related costs. Cash generation remains a top priority for Bax as it works back towards its historical 80% conversion levels, providing the runway needed for near-term temporary headwinds to resolve. 6, Baxter's new operating model, the Growth and Performance System, GPS, has been rolled out and is designed to simplify the organization and improve the say-do ratio. The model removes layers of leadership and embeds critical function roles directly within each business segment, giving segment leaders full P&L responsibility and accountability. This system is aimed at driving continuous improvement, taking a page from CEO Andrew Hitter's more than 10 years at Danaher, ladies and gentlemen. 7, despite concerns around a potential slowdown in U.S. hospital capital spending, management has not observed any signs of weakness. In fact, total U.S. capital orders for care and connectivity solutions segment increased nearly 30% year on year, driving plus 4% global growth in the segment. Management noted that the order book remains strong, with capital spending trends holding up across all geographies. 8, management made it clear that accelerating innovation is a top priority, with plans to ramp R&D spending above historical levels of 5% of sales. And Q4 R&D expense totaled $116 million, or 3.9% of sales, below expectations due to certain cost reclassifications, not reflective of the anticipated run rate level of R&D investment going forward. 9, deleveraging remains a top priority for Baxter, with target reaching 3 times net leverage by the end of 2026. At quarter end, Baxter held $1.97 billion of cash and cash equivalents, going against $9.5 billion of long-term debt, with potential smaller divestitures and portfolio pruning in 2026 expected to support further deleveraging. And 10, management expects fiscal year reported sales growth of flat to up 1%, with organic sales also flat below consensus 1.94. By segment, medical products and therapies is expected to be flat to slightly up. Healthcare systems and technologies to deliver low single-digit growth. Pharmaceuticals to remain flat. Adjusted EPS is guided to $1.85 to $2.05, below consensus of $2.24, with Q1 expected to be the most challenging before improving throughout the year as the bottom line begins to benefit from recently implemented cost right-sizing actions. Importantly, this guidance assumes a worst-case scenario in which the Novum ship and installation hold remains in place for the full year and IV solutions weakness persists, potentially setting the bar for upside if these near-term headwinds resolve earlier than currently embedded expectations. Here are the key points from the earnings call. We've highlighted in green and red. Green is the good things, red is the bad things, and so on. And finally, fear and greed in the market is at fear levels, so we'll see if that bottoms out this week. Active investment managers have taken down or sold after the correction in software down to 80% equity exposure, so we'll see if there's any buying power there. And earnings, consumer staples top 30 weights estimates for this year are up almost 1%, 76 basis points in the last 60 days. Consumer discretionary top 30 weights earnings estimates are up in the last 30 days of 92 basis points as well. And now we are going to move on to our Ask Me Anything questions. Just under 9% estimates, so that remains strong. Estimates remain solid. You can see here $312 per share for 2026, $361 for next year. Those estimates have leveled off a little bit, but they're still elevated. They come down a little bit here for 2026, but the implication is close high teens earnings growth for next year as well. So that's good. Now let's get to our Ask Me Anything questions. We have a lot to catch up on from last week. And first one comes from Andrew Rutherford. Could you take a look at Gladstone Land, ticker LAND? Let's have a look for you. All right. Oh, wow, this one's down quite a bit. Let's take a look. LAND. All right. Right. Have to go. All right, that's a little too crowded. That's a little better. Okay, so free cash flow and revenues have turned down. What is this? Is this just an asset play? Acquires and owns farmland and farm-related properties. Wow. So you're making a bet on commodity prices. You're making a lot of implicit bets in this one. As you can see here with the commodities complex, grains, have been basically killed since 2003. When did this peak? 2022, 2023. So you can see all the grains peaked and have come down dramatically. So you're effectively playing a bet that this stuff is going to come back, and it always does. It's just a question of how long does it take. So if you look at the core ones, soybeans, it can take years. But Trump is going to push the Chinese to buy some stuff in April. I mean, it can take a while for some of these grains. For this, I think it's, what are they doing here? Blueberries, figs, olives, pistachios, wine, grapes. Those are this category. Let's just take a quick look at the financials. This is too many variables that I have to get right to make it work. This is the type of business that probably doesn't belong in a public company. Let's just see if you can get hurt. That's mostly what I'm interested in. Free cash flow has been going down. Balance sheet. Cash is down to 16 million. 1.2 billion of the land. 500 million. So it's 500 million LTV, give or take. Book value per share is 18 bucks. Buying it below book. I think you just have to take a very long-term view. This is not something that we would get involved in, but it's definitely interesting. What's the dividend yield? %5 dividend yield. I don't know if that dividend's going to be good, but I think the assets are probably okay. Not for me, but definitely interesting find, and probably okay for the long term. But I think it's just going to take a few more years than you think to get a recovery. Agathon Rex wants FET. That's Fortum, oil drilling equipment, military communications. This looks like a lot of dilution, my friend. Let's take a look. Free cash flow recovering. Now, keep in mind, you got this thing up 15x or 3x, depending how you look at it. So it's already moved a lot. Let's take a look at the balance sheet. $31 of cash, $160 of receivables. Long-term debt, $137. Revenues have been flattish the last few years after a jump. You got to find out, did they do a deal in 2022? They doubled the share count. My guess is maybe. Revenues seem to jump. I mean, they're not giving you a return on capital yet. Looks like they had a lot of dilution prior. I think this is just going to go in my hard box. Let me just see something here. Income statement. I mean, the theme is right. I think there are better ways to play it. We like National Oil Well Varco. Here is from Sagar SPSY. What is this? Spectra Systems Corp. I think you gave me the wrong ticker. It's not coming up. Let's see. All right, SPSY. Revenues are accelerating. What do these guys do? All right, develops optical systems, security printing, authenticate banknotes and security documents. Huh. This is a very niche business, probably should never be public to start with. Let's take a look here at the balance sheet. 2.6 million of cash. I got 2 million due on the debt. It's all due, so they got to refinance. Share count's been pretty steady. $7 million of free cash flow. Yeah, I just don't know. See the revenues moving up, free cash flow not quite as much. Let's just see if it's just. I don't see the dislocation here that we usually look for. High return on capital. I mean, it seems like a decent business cigar. I'm just not sure what you're trying to do in terms of like getting it at a huge discount, but probably worth more research. I don't think you're going to get hurt on that, but I would check on that debt refinance. There's not a lot of cash on the balance sheet, which is another reason I'm probably a pass, but it is definitely a niche business. What do we got here? On holdings. ONON. Oh, this is the sneaker company. This is a fad. This is like this is these fall. This is like Warby Parker and Allbirds. This is going to eventually fade out. I know, you know, a lot of people wore them a couple of years ago during COVID. I probably had 2 pairs, but no one. I mean, people still wear them and they're being somewhat innovative, but I think this is just going to be a flash in the pan. It'll always have a niche, but it's a healthy balance sheet, high return on capital. Let's take a look at the income statement. They're still growing off a small base. They're increasing the share count. Cash flow's good. Declined a little bit, but let's take a look. So 30 times EBITDA, give or take. 60 times earnings. And what's the earnings growth rate? Okay, so they're going to have big earnings growth next year. $45. 62 price target. I mean, it could push higher here to new highs. This is not the type of business I really want to own long term. And you're buying it up 3-4x off the lows. And I think you're buying a fad. We like businesses that have been around for decades so we can understand how they operate through cycles. This is like you're guessing the future that Organon or whatever they're called is going to be relevant 5 years from now. And I just can't make that bet. And anyone who tells you with a straight face that they know for sure is kidding themselves. Lilly, pass. You missed that one. Chris Booker, Tate and Lyle. TATE.L. By the way, I spent the weekend going through about 3,000 different companies, and it's amazing. There's probably 36 out of those 3,000 still that are tremendous opportunities. There's just so much to do if you know where to look. Let's take a look at Tate. And we re-underwrote everything in our portfolio, and we're still damn confident we have the best names, even relative to those 36, which was pretty amazing. Okay. Tate and Lyle. So this is down about 50%. So are revenues. See if they're doing anything about it with the share count. First off, let's take a look at the balance sheet. That looks okay. Cash flow statement looks pretty good. Let's see. Not bad. Revenues look okay. I don't like that this share count keeps creeping up. Stock-based comp. But I do think that if I wanted to have ingredient solutions, yeah, this is in line with kind of the international flavors and fragrances and a couple others that we've been looking at, and they're starting to move. I think you're probably okay with this one. Nice find, Chris. Next, John H. Teladoc. Oh man, how can you be sure, John, that this is not going to get disintermediated? We looked at this one over the weekend, and yeah, it's like all the fundamentals look okay, but like, how do you not get disintermediated? As a matter of fact, I talked to a friend who is big into this business, and he didn't think there was much value there. This is kind of a runoff. Every group is developing their own version of this. So, yeah, while they were kind of right place, right time, now everyone's like, yeah, we can just set this up ourselves. Let's take a look at the financials, see if there's any signs of strong. Yeah, they really increased the share count a lot during COVID. So they kind of leveled off. The question is, can they hold this share and then buy in stock? I wouldn't make that bet. I don't think they've got anything extra special here other than inertia like Zoom. But Zoom is working hard to get. Yeah, okay. Okay, so Eric's asking about that. Larry Hall, OGN. This is spun off from Merck. Just looks like no growth. 600 million. Margin still declining. Prescription therapies, health, contraception, fertility brands, NuvaRing, prevent pregnancy. So they've been doing $6 billion a year forever. It just like seems like a no growth runoff business. Share count's the same. I don't really have a view on this one. Let me just see. Oh, that's your issue. So they've got a huge amount of debt. So when they spun it, they stuck them with a lot of debt. And that's what the market's worried about. 8 billion, 8.8 billion of debt, 600 million of cash, 1.5 billion of receivables. How much is current? Just 20 million. So you'd have to understand when all this debt comes due, what the free cash flow profile looks years out. I think this kind of goes in the too hard box. You'd really, I mean, what is it? Let's see if you get a dividend while you wait. I just don't see a catalyst. So there's no growth story yet. So you get a 1% dividend. I think it's just dead money. This is where you get stuck in value traps, but I can't find anything wrong with it. I just can't find what's going to change. Kyndryl pass. That's consulting and spun out of IBM, I believe. Let's see here. KPSI. Yeah, as a general rule, by the way, we don't invest in companies that haven't been public for, well more than 10 years generally. There are a few exceptions, but we want to understand how they operate through many different cycles. And these new companies, you're making kind of bets on the future. Joint stock company, what is this description? This looks like way too hard. Fintech solutions for Kazakhstan, Azerbaijan, Ukraine. I mean, can you figure out a more complicated way to make money? I mean, I'm just a hard pass. It reminds me of this guy who, was like 55, 60 years old. And every time I ran into him at a cocktail party, he would remind me how he went to Columbia. And like, I never responded to him that I went to the same school, but he would always like walk around with it. I'm like, why does anyone care? Like in your 20s, that might be relevant, but like, what have you done in the last 50 years? And he would always come up with these super complicated, weird, stupid private deals, rare earths in the middle of nowhere in a dangerous government regime. And, I talked to mutual friends, and of course he wound up with absolutely zero money because he was always complicating everything and looking for some obscure, weird, ridiculous way to make money that invariably at some point guaranteed interrupted compounding, which was Warren Buffett's rule number 1. Don't lose money. Rule number 2, don't forget rule number 1. So yeah, these weird, he was probably one of these guys in Russia that when Russia opened in the 90s, they all went over there and 90% of them lost their money. A couple of them made money on 1 or 2 things like Gazprom, but if the mafia let you keep it. So this is cash, long-term debt, current liabilities, accounts payable, current portion of the long-term debt is $500 million. How much cash? $950 million. Free cash flow. I mean, return on invested capital, everything looks great, but like the reason you're getting that discount is because of the risks that are well beyond your control. So therefore, we'd probably avoid it. Or if we were going to be involved, it would be a function of really small sizing. And if you can only really small size it to manage your risk, why would you be in it to start with? So with that said, you're probably right. And if you gamble and win and everything goes well and you don't have geopolitical things that mess everything up, then great. But why would you take all those multitude of risks when you could just invest in a developed country and buy a good business at a reasonable price, at a great price, and get a double or triple over a few years? Thoughts, advice on pursuing a career in wealth management? I'm a freshman in college. I gave some advice in the speech to the students at USC earlier in the podcast. I think that you really want to make sure that you're adding a tremendous amount of value, aka, if you're a financial advisor, it's going to be a lot with regard to estate planning, I guess insurance, but the days of putting people in ETFs passively and charging a point are over. So it's going to get more and more competitive. You're going to have a relationship edge. So build a network of people and add a tremendous amount of value that they can't get out elsewhere. And the fees that you're getting paid are 1/10 the value you're providing. And if you can do that, then I think there will always be a place for it. I just think it's going to get harder and harder if you're not generating alpha. I mean, if you're generating alpha for people that they can't get anywhere else, they're going to pay you and they're going to stick with you forever and they're going to add more money. If you're giving them beta, they can kind of get that on their own. So the value-added services are going to be critical on what you're providing. A lot of the value-added services now is if you have $10 million with Goldman Sachs, they'll give you a 4% mortgage, or you can access to IPOs for anyone who thinks that's important. But beyond that, you're going to really have to develop a niche and deliver a tremendous amount of service to justify that. Because if you're offering commodity service, I think you're going to get whittled away in that factor. But people will figure it out, as they always do. People said the real estate agents were going to be gone 25 years ago, and they figured it out. So I would say that. Morningstar, that's Alejandro asked about Morningstar. I think that's going to be, this is falling in the software category. Morningstar is a great business. This goes in my too hard pile. This kind of fits in the software theme. Same with FactSet. Someone will make a lot of money off these. It's not going to be us because we tend to avoid software to start with. And parts of this business can be disintermediated over time. Leaving aside the predicting the future, I think you're getting a good business at a reasonable price. But I can't predict what the future is going to look like for this type of business. Right, on a standalone basis, everything looks pretty healthy. This was one of the ones we looked at over the weekend. And despite everything looking okay, we couldn't get high conviction in moving ahead with it. But I think you're probably going to be okay. These are all going to bounce at some point in the next few weeks. And the bounces can be pretty violent. So I think your instinct is right from a trading standpoint. I don't know if this is a business I want to own for years. Same with Monday. This guy says he works at a Caterpillar dealership and he uses it, down big, consistent growth. No way our company could ever get away from it. It's sticky. Well, how'd you operate before it is the question. Let's take a look. Again, this is software, so it's a pass for us. I think a lot of you are going to take gambles on these software stocks and you're going to win. But that's what they are. Don't mistake it for brilliance. It's just that you said sentiment was overshot. And then the question is, when do you get out? I mean, these can all bounce. Monday could bounce to 150 in the next 2 weeks and still go out of business in 3 years. So don't mistake luck for skill. I think this is a rapidly evolving area. I think there will be some winners. Maybe it's the ServiceNows. Maybe it's the CRMs. I don't know, but yeah, I mean, it's totally pricing in death. And if it doesn't die, you're going to make a double plus. Work operating system, cloud-based, modular building blocks, create software applications. So this goes in my too hard box. I hope some of you make money off them. We will not be participating. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. CoStar Investment Group, same thing. CSGP. This is a great business at a good price. You just have to understand how it can or cannot be disintermediated. I think the reality is often a lot less than the fear, but you have to be damn certain before you go into this, which is why we avoided it before the software fear, and we avoid it now. Free cash flow is negative. For, online market services. This one's a pass for us. Again, it doesn't mean it won't work. Marvell. This is from David T. MRVL. It's up 15x already. What do you? I'm not sure if this is the time to be getting interested when everyone else is interested, David. So welcome to the podcast. You're probably newer here, which is fine. We're super happy to have you. Yeah, I mean, this is a good business at a probably stretched price. Let's see here. Dividend yield, payout ratio. Market cap. Yeah, I prefer to buy things when they're down a lot. So this thing is up 150% off its recent lows. Probably pushes a little higher, but it's not going to meet our hurdle to get a double plus in the next 3 years, double, triple. So for that reason, pass. This guy's asking about JD and Pinduoduo because he missed Baba and Baidu. I would pass on those two. Datadog is a software stock. You know, there are a lot of people that were bullish on China and all in on Neo, and that hasn't worked. I think you can only, you know, the thing that's made us great and what we discussed with the students at USC is we try to buy the highest quality asset in the most dislocated sector. So we can ride through the short-term volatility and sleep well at night, knowing that the cycle will eventually play out, and this will be the last man standing. The big will get bigger. The small ones, some of them, maybe you can get a better IRR, but you're also coin flipping if they're going to make it through the cycle. I don't know. I wouldn't want to compete against Alibaba with Jack Ma in the picture, and I think Pinduoduo and JD are finding that out. There'll be a place for them, but I think all the money is going to be going into Baba, Baidu, and maybe Tencent to a lesser extent as the flows continue to happen. And maybe they'll catch the last part of the cycle. Those things will get bid up parabolically, but why would you want to be in those? Brett Lamborn, Datadog. What price would I be a buyer at? No price. absolutely no price on software. I have no edge, and it's a pass. DDOG. You guarantee that it can't be replicated or disintermediated, and I'll take a look at becoming an investor in it. But we've always avoided software for that. We learned from the best with Warren Buffett. Sure, he missed Microsoft, but he made a few $100 billion. He did just fine. Manny B, we stay in our lane. Circle Internet Group, stable coin based financial platform, digital assets. Hard pass for us. This is a guess the future type of stock that we don't play with. Okay. CRCL. Welcome to the podcast, by the way. I'm assuming you're pretty new, and we're grateful to have you here. Oh yeah, a friend was telling me about this. Yeah, not for me. We stay in our lane. We have no view either way on that. And with the software stocks, by the way, again, I think there are going to be people that make a ton of money off of this bounce. We're just not going to play that game. That's a gambling game. It's like if they don't, they lose another 50%. If they do, they double their money. It's kind of like betting on the Patriots to win the Super Bowl at even odds. It's like, there are better ways to make money. Mark Baum, thanks for the great videos you keep sharing with us. Want to ask how much anything large? Oh yeah. So these are questions about what if they spin this and what if they break off that. All of this is breaking into two companies. Questions about PayPal. There are Braintree, Zoom, Zettle, spinoff, blah, blah, blah. All of those are on the table. The key is with all turnarounds, you want those outs, things they can sell, things they can spin. But the most important thing you want is $6 billion a year in free cash flow to buy back stock and to buy you time for the turnaround. So I can't predict how much is Zelle worth if they spin it and this and that. What I do know is I'm buying with an enormous margin of safety, and we've now brought our basis down into the 53s, by the way. So good things happen when you buy good companies at great prices that generate cash, that have a healthy balance sheet, and now we have another potential catalyst for change. So I'll leave it there. Daniel Murphy, KSPI. I wouldn't buy it for the dividend. Same thing. Okay, pass. That's that Kazakhstani thing. CCI, he's asking about DirecTV and all that stuff. We'll cover it in coming weeks. The bottom line is there's two major games in town. We want exposure. The demand is increasing. You got American Tower and you got CCI. We're sticking with CCI. They've cleaned up. They've done most of the heavy lifting. They'll catch a break in the cycle. Rates are going to get compressed. I could buy CCI or I could buy TLT. I like both of them. I think CCI is better because it's an operating business with free cash flow. But as TLT gets bid in the middle part of this year and 10-year yields compress below 3%, CCI is going to get bid. Lindsay Hines, love the show. I noticed that some of your companies tend to fall on earnings and then recover weeks after. Is that because the market doesn't understand earnings usually? Any thoughts on that, or is this just noise? Love Lindsay. Love Lindsay. Okay. Love you too. The answer is it's just short-term noise. And, it's funny. I was playing golf with a guy who has an insurance company, and I won't say which one. And he had that exact same problem. They reported everything, beat and raise. And what happened was the stock was down like 20%. They literally beat top line, bottom line, big time, premiums written. Stock got hammered down like 20%, like PayPal style. Guidance was super strong. So they just decided to buy in the stock and it recovered within a few days. And what they were told is it's like this hedge fund debasement. So there's so many hedge funds this quarter that are literally going out of business and getting liquidated because they were all crowded into the AI trade and overweight software and overweight all the things we told you guys to get out of for the last 12 months. And they're just trying to find liquidity anywhere they can get it. So they take the companies that report good earnings, hoping that they can sell the strength to raise cash to handle their margin calls and redemptions. And that's just what you're seeing this quarter. And I think that it's mostly that the algorithms tend to overshoot. They automatically read these things. So, someone asked me earlier this week, what do you think will happen to investing with AI? I think the short-term investors that are trading inside, weeks, months, and inside 12 months are going to get arbed out, and there's going to be no future for those people. That's 5 to 7 years away. I think the people that take a long-term mindset of 2, 3, 5 years, there are going to be more and more opportunities like never before, because the algos are programmed by humans, and humans are designed to chase the herd. So they're mostly momentum traders. So the deep values and the turnaround opportunities are going to be left until they're not. And then once they're found, they're going to get bid up extremely, extremely quickly. So they're going to just be huge opportunities that just go like that. And then everyone else chasing the momentum ones, when people get out, they're going to just get crashed. So I'm excited. I think there's going to be more opportunity than ever before. Names Opera, OPRA. Yeah, this is up 7x and it's pulled back a little bit. This is not where we tend to be interested. People are still interested and want to buy that dip, but let's take a look at what they do. Margins continue to decline. I'm probably a pass on this one. Oh, this is a web browser. No, hard pass on that one. American Superconductor, AMSC. Yeah, this one you kind of missed. You're getting in when everyone's interested versus when no one was interested. Was up 25x off the bottom. It's pulled back a little bit. Now you're interested. So I would avoid those. When these things break, let me just take a quick look at the financials. Obviously, it's gone up 25x because things are starting to turn around. The question is how much of that is priced in. I'd be a pass on this. Find me something that no one wants, and we'll get interested in that. Admire absolutely love your videos. Look forward to them. Admire your honest thoughts. I've learned so much. I share your videos each week. Well, thank you, Jennifer. I appreciate that. Vail Resorts. Yeah, I understand this. I don't really like these businesses. I'm going to Whistler for a few days this week. This has obviously been a beast. Let's take a look. I'm not into the amusement, like fun, Six Flags and all these. They tend to just come in, Churchill Downs. They just tend to come into periods where they get hit, and they get hit so hard. Cash flow. All right, let's see what's happening here. Cash flow's come down a little bit. Revenues have been pretty steady. Let's see if they're buying in any stock. Well, first off, let's look at the balance sheet. $500 million. $500 million, that looks okay. It's a pretty steady business. Cash flow is good. Seems to be well run. 6% yield. Well, Jennifer, I'm not going to be involved with you, but I think you're probably going to be okay long term on this one. So I'm not going to say no. I'm just not going to participate with you. Sunil Shroff, Sweet Green. This is a tough one because this is in the investment group and they're in their growth phase and they've kind of gotten a little bit hit on the balance sheet and people are worried about that. I wouldn't bet against it because I happen to know some of the people involved and have high confidence in them to turn it around. I would not be in it personally just because free cash flow hasn't turned positive yet. I'm sure it will at some point. So turnaround's a heavy lift. They're still in growth mode. You know, you walk by all the stores, they're all crowded. People love the product, but for me, let's just see. Got 130 million of cash. Current liabilities, 115. No long-term debt. That's good. Is that true? Yeah. Wow. Okay. So they'll live to tell the story. Let's see here. Cash flow. How much are they burning? So they had a tough burn in the last 12 months. Probably opening up a bunch of stores. What are they doing to the share count? I mean, you're seeing the growth here. They're opening stores. You know, a lot of increase in share count. They've kind of steadied it a little bit. What are they paying themselves? All right, they brought it down a little bit. Yeah, I think this is a wait and see story. When they turn cash flow positive, even if you miss some of the upside, I'd be inclined to wait on that. But I do like the restaurant theme. Giant Patel and Molina. Yeah, the problem with that is the exposure to Medicaid. And if I'm going to get involved in that, I probably want UNH or Humana before I want Molina. But if you look at their financials, this was one of the three that I looked at this weekend. It's probably going to be interesting at some point, but I'd play it through UNH or Humana before I played this second tier peer. Again, the highest quality assets in the most dislocated sector. These Medicaid exposure insurance players, I'd just rather have some. Humana has disproportionate amount of exposure relative to UNH, so I'd probably be more inclined to buy UNH if we got to dip back below 250. But for now, it's a pass. And finally, Brandon Lee asked about NUTX, a specialty hospital company. NUTX. So this has already rallied 35x off the lows. So for us, it's a non-starter, meaning we did not get involved. If we're buying it up 35x, we did not get involved when no one was interested. We're now getting involved when a lot of people are interested, and that's a very tough way to make outsized returns. Obviously, the financials are improving, which is why it's up. $35x or whatever it happens to be. Let's take a look at the income statement. Yeah, they're increasing the share count a little bit. Let's just see what they do real quick. Population management. Yeah, I saw a bunch of these population health management businesses in our review of 2,500 companies this weekend. I think one or two made the list. This was not one of them. So for that reason, I'm a pass. Do want to thank everyone for tuning in this week. We'll be back next week. We might be a day late next week. It's either going to be Thursday or Friday. We'll be back in California, off to New York next week to do all the TV. So there's going to be a lot of media next week. Not much this week. A couple days in Whistler with the family. And we'll talk to you then. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.